Excel screen. Can you see my Excel? So yeah, great. All right, so this is the point. We looked at residual income model. We look at the free cash flow. Yesterday we looked at residual income, and then we started looking at multiples. So I mentioned that I was going to provide the multiples, and then you'll use that for the work we're going to do today. What I want to say here is that I must be honest here to tell you that I have not really had great time to put together the multiples for sub-Saharan Africa region. You can try that yourself. So for the purpose of what we do today, I'm going to delete the sub-Saharan African region since I've not taken time to really put the multiples together. So we work with Ghana. I'll use Ghana to demonstrate. And then, of course, you can improve upon your work by looking at the multiples in the sub-Saharan African region, right? You can do that on your own. And that'll be beautiful. You can select some banks in the space and do that on. Okay. Now, so let's get straight and talk about the business today. Today, we are going to do some filters. Number one, we are going to, let me list it there, complete, let's say, conclude on the value estimate for GCB. That's the first thing. Number two, we are going to simulate the path of prices at different the paths of prices, let's say towards, no, let me not say path for a reason. We are going to simulate possible prices at different at various times, or let's say states in the future. So we're going to do that. So the first one, we are going to conclude on a value estimate for GCB. Second one, we are going to simulate possible prices at various states in the future. The third one, we will determine, so let me say, determine price targets. Okay, we determine price target. And the fourth one, we will take a look at research report, and by extension, by extension, business valuation report. So these are the four things we are going to look at today. And we are going to start with the first one to conclude on the value estimate for GCB. Let's start. So we got some estimate for free cash flow to equity, for residual income. Of course, there are some few other things to do. And we use calculating for both, we use the cost of equity, then market multiples. As I mentioned already that I don't have the Sub-Saharan African estimate, so I'm going to ignore that for a moment for the purpose of what I'm coming to do. So this is my comparable universe. And maybe let me delete the Sub-Saharan Africa. Let me do that at once. Sub-Saharan Africa region here deleted, and no fail. So I have the various comparable banks on the Ghana Stock Exchange. I just compiled the banks on the Ghana Stock Exchange. So Standard, EcoBank, Access, Societe Generale, ADB, Republic, and Carbon. Now for ADB, I could not find the 2024 audited account. So I used the 2023 and audited, I used the September 2024 and audited, and I round it up, right? I round the earnings figure out to 12 months, and I added that to the beginning balance again. So based on that, I was able to estimate this. So you should know that this is an estimated value. Of course, ADB is not going to be that useful to us also because ADB stock prices, have been stable for a long time now. So I'm going to be switching between multiple pages today. So for example, let me just show you some few stuff. If I stop sharing, I want to share my this screen here. You can see the site which I'm the African exchanges. So when I come here and I'm looking at a bank like ADB, I hope you can see this screen. You see a bank like ADB, you come down and then you tend to see the market price. The market price has been 5.06 Ghana cedis for a long time now. In fact, when I look at that over a very long time period, since 2019, May 2019, the price have been the same until now. So over 6 years. 6 years now, the price has been constant, right? The price has been constant. And you can tell me that the price shouldn't be moving and all that. But one thing you need to know is that the government actually is a dominant player. The government is not even trading this year. So us, nobody really, you are not going to see much volatility, right? You are not going to see even any volatility at all. When we take, let's say, Car Bank, and we check that of Car Bank, you see some good trading here, especially this particular year. So between January and May 25, so much trading, right? A lot of trading going on. So you could see the volatility, you see it changes over time. But generally, you see the stock price rising. And of course, we know why the stock price drop has been drawing consistently in the past because of capital issues the bank had. But of course, as they restore their capital in 2024, you could see some improvement up to above 0.75 or 75 pesos in between May and March and May, and then drop again below 0.75 because there's so much pressure on it to drop. So, and then maybe we can check another one. We can check, let's say, Standard. We can check Standard to see. Let's check Standard. Okay, so on Standard, if you look at it, have I passed there? I think I did. Now, if you see Standard to, let me do for, this from July, right, 2024. So you see the price rise, and of course, has risen from somewhere below 20 to above 25 now. So the share price is the share is actually doing well in terms of that. But of course, you see the volatility is generally low. Look at the banks, the volatility extremely low. And so those are reasons why I told you that the use of Ghana Stock Exchange itself is something which I don't recommend when you are forming this expectation of a long-term equity market. This thing doesn't make any sense to me, right? No volatility. Look at something from the 24th from November to January. See, the price has been constant at 23. Okay, and the valuation we are doing, we are using 31 December as the valuation date, 31 December 2024 as valuation date. So the figures I picked for stock prices were all as at December 31, right, 2024. But then when we go to other markets, let's go to other exchanges. Let's go to Johannesburg Stock Exchange and let's just sample some banks there, right? So let me look for a bank. So let's look at Absa Group here and see what's happening with Absa Group. So look at it. Look at the volatility on the market. This is a better market. You can see, right? And if I see this over a longer period, you see that so it's up and down, up and down, up and down like that, of course. So, but you see that in most cases, the price was in between 150 and then 200, right? It has been in that band. But generally speaking, if you look at it over a broader sense, it's between 100 and 200, of course, it widens. And so much trading was going on in the market. If I look at it over a 3-month period, you start seeing this, that the share price actually trending down for Absa. And the reasons which I don't know. And if you look at it clearly here, you can see that it actually moved from 170 down to, between 170 and 165, of course. That is upside. If I take another bank, let's look at the standard group. See what's happening with standard group. There's a great volatility here as well, right? And the higher the volatility, the better the market, right? What it means is that trading is playing a role in the volatility. Yeah. There's no trading in the stock. You will not be likely to have price discovery, and you will not be able to discover prices properly. And so this is what is happening on the market. So I tend to trust market like this than our market, even with market like this, in forming those market expectations, we don't use them. South African market is not matured enough to be used to form those expectations, right? Because you see, when we say this, you may think, oh, of course, you are working in Ghana. Why are you thinking about the market is not this, the market is not that? You see, the reason why we don't use them, and I explained all that in earlier lectures when we were dealing with economics of banking, and also when we dealt with the discount rate and stuff. I explained why. Because when we're using a CAPM, the assumption is that we are looking for the equity risk premium for a matured market. It must be a matured market, or a market where the investments are highly diversified. Okay, they're extensively diversified. And our market doesn't qualify. See, our market doesn't qualify. But once we get a CAPM and all those things, and the equity risk premium and all that on a matured market, all those things back in, then we can add other items to the CAPM to extend the CAPM so that it gives us something in the market here. Of course, which actually we call, I gave this very nice name called the emerging market equity, cost of equity model, that I often use, and almost everyone that is practicing these and I've been using. Of course, so even if you go to some exchange like in Nigeria, for example, let's go to Nigerian Stock Exchange and let's check some of the banks there on the Nigerian Stock Exchange. So you go to several companies listed here, right? I'm looking for a bank to show you what is happening in Nigeria. Okay. EcoBank Transnational, I want to leave it because reason, Fidelity Bank PLC in Nigeria. Maybe let's check that out. Fidelity Bank PLC. So look at this. You see the trading, you see the volatility in the prices here. You see the level of volatility. If you look at it over a 6-month period, still look at it over a 1-month period, you can still see the volatility, right? At least something good is happening compared to our market here. Our market here, just a few stocks are being seriously traded, right? So if you go back again, maybe let's check one more bank and we'll come back to our market. What's happening? I'm not able to. Maybe let me go back. A step back. Okay, so if we check one more bank, exchange group, blah blah blah, NPF Microfinance Bank. Well, let me check the Microfinance Bank, or I think I should have Access Bank here in Nigeria, and cool. I don't know why. Access Holdings, yeah. Access is here. Let me check the holding company. Even look at this. Look at the volatility. Let's go back to our market. So we check on something. So our market here, let's check GCB. The market we're dealing with. GCB, let's check GCB and see how it's looking like. So this GCB and GCB stocks, look at that also, even when viewed over a 1-year period. But it's been rising, and that's one beautiful thing about GCB stock. I'll tell you some nice story about this. Let me view it over a longer period. So you see in 2016, in 2017, of course, we experienced those kind of like the cleanup, blah, 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 and all that, but not significant impact. Then it shot up here in 2018. The DDP set in 2022, in 2022, that caused the stock price to drop significantly on the announcement. The period leading to the announcement in August, it fell. It fell again by May 2020, February 2023, fell seriously here. And then it stayed low and then started rising. Of course, so we see it rising to this value. Now, the interesting that I want you to note is that we are going to be valuing the bank at this level. As it stands now, we are trying to get a value as of December 31, which is going to be around 3.4. The price was 3.4 then. So we are trying to get that. But don't forget that as it stands now, the price is 7.6. It's more than doubled since then. So let's be mindful as we approach this way. Good. Thank you very much. I think enough of that. Let's get back to ISL. Now in ISL, so you see the bank we just dealt with, and we have the market value. And the market value, is as of 31 December 2024. And the market value, I computed it by multiplying the share price by the outstanding number of shares. And this is the book value of equity picked from the balance sheet. We have the return on equity displayed here. And this growth here is a growth in profit after tax over a 15-year period. So this is a growth in profit after tax. Let me state like this: growth in profit after tax over a 15-year period, or a 15-year period. And that is from 2010 to 2024. So that's what I got from all the bank, 2010 to 2024. So 15-year period. And so this is the growth, the compounded average growth rate, or the CAGR of whatever. So I think, let me even edit this. So let me put it here, that CAGR of profit after tax over a 15-year period. That's what we have here. So you could see the bank whose profit is growing faster. We could see the likes of Access Bank taking the lead, and then also EcoBank is doing quite well, and the rest, right? Okay. So then I computed the price to book ratio, and we can see the price to book ratio. And the type of price I'm using is the price at the end of the year. Okay, 31st December. That's the price I'm using. There are some people who will use the average price in December. Some people may even use average price for the last quarter of the year. And I'm using the price at the end. So I'm just explaining to you the price that I'm using, right? The convention that I'm taking when it comes to things like this. Okay, so we have this here. We need to come up with a comparables, and I want to bring this below here. I want to bring it below here. Okay, and I'll delete it from there. I want to come up with comparables. Now, the whole idea is this. We need to know GCB's position. What's the characteristics or the features of GCB as far as some of these things are concerned? Let's look. We may be thinking about, well, what if we compare GCB to these? How is it looking like? And I mentioned to you that the main drivers of value are cash flow, we have risk, and we have growth as well. So growth, I have growth here computed. The cash flow here, think about it like the return on equity, and that's the cash flow here, return on equity. And then the risk side will be the cost of equity. And the cost of equity will seem to be similar across board. Just the only difference would be around the fact that some banks may be bigger than some may be riskier than some, and all that. And GCB is kind of like a bigger bank and a more stable bank, and among the top 5 banks. So those that are part of the top 5 banks, we can agree that to some extent that they have a similar risk profile, like EcoBank. EcoBank is among the top 5 banks in the country. None of the banks here, apart from EcoBank, is part of the top 5. Okay, so GCB has a very good risk profile to start with. We can also think about banks that are listed, the banks that are local and banks that are international. Banks that are local, the risks associated with them tend to be higher than the banks that are international. Like Access Bank, the risks associated with the Access Bank, the specific risks will be lower than the risks associated compared to the risks associated with, let's say, Car Bank. That's more of a local bank, right? Or ADB, or even GCB. But one thing also to say is that GCB is one of those big to collapse banks, right? It's too big to fail. So those big to fail banks tend to have a lower risk as well. Okay. So let's look into the multiples. And when we see the multiples here, we have 1.51. We can do some basic work here. Let's look at the minimum, and let's look at the mass as well here to see. So the minimum here, we can use the mean function, and let me take the minimum. I'm going to exclude the ADB because ADB is quite a clear outline. Of course, ADB is of the share price. The shares have not been trading much, so you see that it's kind of like an outlier. You can see it from here. It's an outlier, clearly an outlier. ADB is clearly an outlier. So we have taken ADB out. So the minimum is 0.38. And let's see how the maximum will be like. What's the maximum price to book ratio here? And let me just change to here to mass. Maximum price to book ratio. Mass. That's 1.74. Now, 1.74 versus 0.39. Now, there are some few things I like to see. Let me see the median price. I don't know why. The median price and median. Let's check the median price and see how it's like. The median price is 0.54. 0.54 is a median price. The median price to book, right? 0.54. The minimum is 0.39. Then the maximum is 1.74. Now let's see what price to book is trying to do. Price to book is saying for every $1 of the book value, we are placing these values on them. So 1.51 for standard means that for every, I think this is supposed to be EcoBank. It means that for every 1 CD of the book value of equity of standard, the market is pricing it to 1.51. And this is very high, as you can see, right? And then let's say the highest one is actually Cal. And I understand Cal as a clear case because just recently, Cal issued some fresh equity. So of course, it's possible to have something like this. And let's look at it. Cal issued some fresh equity, so fresh money has come in, and it came in at the end of the year. Let's see how the stock price actually behaved at year end when these equities came in. So I'm here again. I'm going to the company and I'm going to Cal. Let's see how the stock price behaved when the money came in. So the money came in end of year. And maybe around end of year, I'm putting it that way. I've forgotten the actual date. But afterwards, you see the price start rising, right? Of course, there's some confidence restored in the bank. So the price started rising, especially when the news of the money coming in, all that, blah, blah, blah. It's brought about some revival of the bank. Okay. Now, given that, we can say that as it stands now, the share price is higher than before. So a higher share price before, a higher share price after the money coming in will imply that if we are to recompute this price to book, it will even be more than 1.74. I don't want to work with this, clearly. The reason being the nature of the bank and how the money came in at the end of the year and all that. And this situation is distorting the price to book ratio. So I will not want to work with it. So let me paint that red. Now, when I look at Republic Bank, for example, that's about 0.57. That's Republic Bank. Standard itself is about, let me check this one, something here that you don't have access to yet. Okay. Now, standard itself, our 1.51. I want us to see something really quick here. I'm going to bring GCB Bank multiples just below the car bank. And let's check something. Let me bring GCB just below the car bank for us to check something. Shift down. Okay. So, I'm going to bring here GCB Bank. So GCB, so we have GSE, GCB. And market value of GCB, let me just put that here. GCB market cap. So that is this. Since everything is to the nearest 1,000, we have this. There's GCB's market cap. And the next thing, book value of GCB. Let me check that as well. Book value of GCB, annual year-end book value, right? So that is these 1, 2, 3, and then the return on equity for GCB is this GCB return on equity. Have that to be this. Yeah, and then finally, GCB price to book ratio is going to be this. Will be this. Okay. Now, one more thing, the growth rates, the growth in earnings. So let me do that quickly. So the net profit is this. I have my database here. A database somewhere that I used to do a lot of computation. So I'm doing that in a second. Have that here. So the growth rates, RI, you are not seeing the screen. Okay. So don't worry about that. So just trust me that I'm doing the calculation accurately. So the growth in earnings is the component average growth in earnings have been calculated, and that is this. So let's compare GCB's numbers now. Let's do the comparison. So if you look at the price to book ratio of GCB currently is 0.42. 0.42. But if you go back to the exchange, the price now, based on the price we are seeing on the market now, where should GCB be? Well, let's check it out. So I'm on the exchange now, and I'm looking for GCB, and let's get the current price. If let's say we are trying to calculate the price to book ratio today, May 13, or yesterday, May 13, the closing price was 7.6. Closing price of 7.6. So if we are to do the computation based on yesterday's prices, 7.2, the price to book ratio is going to be the value I'm copying and pasting here. It's going to be, instead of 4.2, it will be 4.7, 0.47. So you see that there are no significant changes in the price to book ratio. Okay. Now, good. So I'm still keeping it as the previous period price. Now, so we have this standard is 1.51, and clearly you are looking at these market values and feel like, well, are we trying to say that standard market value is bigger or higher than that of GCB like twice? EcoBank, of course, can be justified in a way. Societe Generale to is looking good, but the gap between EcoBank and GCB not that huge. And of course, for me, if EcoBank is 2 billion and GCB is 1.6 billion, Not that significant variance, given that EcoBank is the largest bank in the country in terms of customer deposits. GCB outperformed EcoBank slightly last year, but EcoBank is still the largest bank in terms of total asset and all that. In fact, even when we come to let's go to the top 5 banks, and you see the performance for the profit for the year. You see EcoBank is booking 1.6 billion, followed by GCB 1.2 billion. Now, I talked about deposit. It is where GCB is doing 34 billion, EcoBank is doing 31 billion. But in a previous period, EcoBank outperformed GCB. Now, when we get to the loan side, EcoBank has more loans than GCB. Think about it. Investment security, GCB here is topping. Total assets, EcoBank is still topping, 45 billion compared to 42 billion from GCB. Now, and given that EcoBank is a well-diversified bank, if I say well-diversified bank, this is a Pan-African bank compared to GCB that is only less essentially and simply put, only a Ghanaian bank. Think about it. Just think about the whole thing. So putting EcoBank's value above GCB it makes a bit of sense, right? But then Standard here is quite overvalued from my perspective. GCB is a local champion. Oh no, I don't want to call it a local champion. Actually, GCB is one of the best banks in the country. And if you get to know the details of the figures, you realize that the guys have been doing very well, right? Okay, so even if you look at EcoBank, the growth in earnings is about 27%, GCB is 24%, ROE is 31% for EcoBank, GCB is 35%, right? But we can also look at the path followed by the ROE ratio, the ROE over time. If you look at it, you may consider EcoBank to be performing better than GCB. But with all this, look at the price to book ratio of EcoBank. It's still lower. So GCB too is like this. Okay. Now, Standard, as I mentioned, is overpriced in my view. CalBank is not something I want to go for. And so I'm going to be left between the EcoBank and things and Societe Generale, Access Bank and all that to use that as basis. One thing is that someone will also ask me, so in my view, don't I think EcoBank too is understated? Yeah, it's possible EcoBank is understated. It's very possible that EcoBank is understated, right? It is something, an argument we can make. I want you to check something right now. Let's consider EcoBank and GCB to be banks that are all stable, right? They are large bank and they are growing. They are mature banks. Let's consider it aside. We know we can actually calculate the justified price to book for these banks. Maybe let me do this quickly. Let me close this one up and do some computation here for you to see. So we can calculate the justified price to book for these banks. Let's see that. Justified price to book for EcoBank, and this, maybe let me bring this down instead, so I can do the computation below. Or another way I can do it, I can do it. No, let me just do it below here. So I'll call these other statistics. Let me do that quickly. So let me shift this down. Let's look at this. I'm calling this justified price to book ratio. And so let me do for two banks for you to see something. EcoBank and let's say GCB Bank for these two banks, right? So of course I have their ticker symbols here. And then GCB2, I have that here. Now, the justified price to book ratio, this is what I'm going to do. I'm going to make a simple assumption. First, I will use the information I have here to come out with the maybe before I do the justify, let me come up with the implied cost of equity. Cost of equity for these banks. The cost of equity implied by the 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 price to book ratios we have here. Let's do something interesting here. The cost of equity implied by them, cost of equity. Let's do that first. Cost of equity implied by them, you know very well the formula that the price to book from yesterday is equivalent to the return on equity minus growth rate divided by the cost of equity minus growth rate. So we have the return on equity, which is this for EcoBank, minus the growth rate for EcoBank. So here we can use the growth rate for the growth in earnings, right? Let's check some few things out. And then we divide this by the cost of equity. And here, let's say, no, we divide it by cost of equity minus growth rate. And that's the formula we know. But we can make the cost of equity rather the subject. In that case, if we make cost of equity the subject, let's do the algebra. Very simple one. We have return on equity minus growth rate in the numerator. So we're going to do some cross multiplication. So here, we are going to have the book value multiplying the return on equity minus the growth rate. And then when we have the book value multiplying that, we also have the price multiplying the denominator, which is return on equity or cost of equity minus the growth rate. Now, so we take P to multiply return on equity, cost of equity, and then also the price, the P, to multiply the growth rate as well. So we can take the growth rate and the price, or P times G, to the other side. Since it is cost of equity minus G, when we move it to the other side, it's become a positive. So we are going to have the book value times the return on equity, the book value times, in the bracket, return on equity minus growth rate, and then plus the price minus the price times the growth rate. So what I'm talking about is this. We take the cost of equity, which is KE, will be equal to the book value multiplied by the return on equity minus G, that's a growth rate, minus G, then minus the price, plus the price times G. So something like this. So this is the formula for the cost of equity. If you want to calculate the cost of equity implied in the price to book ratio, let's see. Now what it means is that I need a price. And again, apart from price, I need the growth rate. I know the growth rate. I know the ROE. I know the price as well. So I'm cool to go. So this EcoBank's price, the price for EcoBank about 6.5. That's 6.5 on the 31st December, 6.5. So we know that price will be 6.5. So what do? We come here and we do the book value, and let me just say something. Instead of taking the price, I'll just say market value and book value. I'll use that one, the 2,000 here, right? I'll get the same thing. So what's the formula? The formula is the book value here multiplied by the return on equity minus the growth rate, bracket close, plus the price, which is the market value, times the growth rate, times the growth rate. What is the growth rate? This. Hit enter. I think there's an error in my work. I'll have to correct. Let me see something. This cannot be accurate, or maybe it is. Now, there's a problem here. Let's deal with some quantities. Maybe what I can do is that, because I'm not writing anywhere, let me check the algebra. So we have the price to book ratio. So rather, I'll take the entire price to book ratio. Okay, so let's look at it this way. The numerator stays the same, which is ROE minus G. Okay, that's the numerator. The denominator is, we know, to be cost of equity minus G as well. So what we can do is that we use the price to book to multiply ROE minus G. And so in that case, we are going to have ROE minus G. Then we will multiply that by price to book ratio. Yeah, we multiply that by price to book ratio and equate it to this. And then this will cross the equal to sign. So at the end of the day, we are going to be adding the G rather. I think someone has done something. Everything will then be divided by price. Yes. Yes. So let's take it out to see with this I just said. So we have the ROE, which is the 35 minus the growth rate, and then we multiply that by the price to book ratio. I think I'm picking a wrong thing here. Let's move this also here. So we multiply by the price to book ratio here. Good. Now, so did I say a multiply? What is happening to me? Okay. So I have the ROE minus the growth rate. Let's calculate that first, guys. ROE minus the growth rate first as the numerator. Then this ROE minus the growth rate and the numerator. So this is what we have, ROE and the growth rate. Let's put that there somewhere. So this is what we have. Now, what we're going to do is that we'll multiply the denominator by the price to this thing ratio and divide it through it again. So we can divide these now by the price to book ratio. We divide this by the price to book ratio. And then it gives us this. But then we will need to move the growth rate to the other side of the equation. So we will add the growth rate to it. So this is a correct one now, guys. Plus the growth rate, which is growth in this. 38.64. Okay, guys, have you seen this? 38.64. So this is the cost of equity the bank is pricing in, or the market is pricing in. This is the cost of equity the market is pricing in for EcoBank. Let's look at the cost of equity the market is pricing in for GCB, just based on the figures we have. Let's look at the cost of equity the market is pricing in for GCB. So let me move this to GCB, ETB, GCB, 50.21. Guys, can you see what's happening? So this is the cost of equity pricing. However, note the assumptions. The assumption we are making is that these banks are all matured banks and they are growing at a stable rate. That's the assumption. But then with that assumption made, this is what we see happening. Now, this is what the market is pricing, but this may not necessarily be what is or what the fundamentals of the bank is saying. The bank fundamentals may be doing something else. Okay. Now, so this is what we can do. If we want to check what the bank fundamentals are doing, we can calculate. So this, we call it implied cost of equity. Implied cost of equity. And then these will be actual cost of equity. Actual cost of equity we have here. And here, we want to have the implied or the justified price to book ratio. Price to book. So the justified price to book will be based on the fundamentals of the bank. That is looking at the bank financial statement, all that we've been doing. That constitutes the justified price to book. Okay. So let's check that one and see. So actual cost of equity let's assume that the cost of equity, of course, for GCB and by extension, EcoBank, let's say they are all the same as it stands. But GCB, we may add something to it. But let's just calculate based on this cost of equity we are even yet to refine. Now, based on that, what will be the justified price to book ratio for EcoBank? That will be the return on equity minus the growth rate. Return on equity minus the growth rate. Then return on equity minus the growth rate divided by cost of equity minus the growth rate. Minus the growth rate. Let's see how all that gives us. Well, that's going to give us 1.74 times. Okay. 1.74 times. Now, let's do the same thing here. Bring this here, bring this here, bring this here. Hit enter. 3.37. So based on the fundamentals, this should have been the justified price to book. But based on what the market is pricing, the market is pricing this. So let me just bring market here. So market price to book, or trading, or traded price to book. Okay, so for what is traded on the market, this is what we have. But what the fundamentals are saying, this is how it should be. I want you to check something. These are the fundamentals are saying 1.74, 3.37. When we did the return on the residual income model, we got the justified price to book ratio for the base case being 1.87. 1.87 before liquidity discount. Look at the word. Look at the ratio, the multiple. 1.87 versus this 3.37. Okay, now this is the justify, and this justify is assuming that a bank is matured, and this is a traded. The traded is 0.42. In fact, it actually lies in between them. Okay. Now, I was just trying to show you some beautiful things, right? Now, when we check the banks we have here, we can see clearly that the cost of equity implied in GCB is just too high. If we assume that the traded price to book is it should be the ideal thing to go with, the cost of equity implied in it is just too high. Now, if we look at that of EcoBank, to some extent is justified, to some extent. But because of the low volatility on the market, sometimes it's difficult to justify if some of these ratios or multiples make sense at all. A lot of people argue on this, right? Okay. Let's pick some few multiples and do some work with. Clearly, Standard, we are taking it off. EcoBank, because if we are to calculate this implied cost of equity on Standard, let's see how it should have been. It would have been if it happened to have been Standard. Let's see what Standard will give us if we're doing this on Standard. Standard will be giving 29.33. Ooh, and look at the actual cost of equity we calculated, 27.79. Now, could it be that Standard is rather accurate? But don't forget, we are here to provide company-specific risks and all that to this one, cost of equity, right? But could it be that Standard price to book ratio is rather the correct one? Yeah. So those are some of the questions that we can ask. Let's check which one. Let's check Société Générale and see. So moving into Société Générale, let's see the implied cost of equity in Société Générale. I'm not done. Société Générale, implied cost of equity, 17%. Definitely that is too low. So the cost of equity price in here is too low. It could also mean that based on the fundamentals of Société Générale, the price to book ratio could have been lower than this. Now let's make it higher. Let's say it's actually higher than this to this value and see how the behavior was like. So Societe Generale, it could also it could be that the price, or clearly you can see that the price to book ratio is too low. Check it out. The reason is that the higher the price or the higher the cost of equity, the higher the price to let's check the relationship well before I do the wrong conclusion. This is cost of equity, right? Now, if we move the price to book from 0.43 to 1.51, look at how the cost of equity is going to change from 17% to 23%, right? Good. So it tells us a very beautiful, or we can draw a very beautiful conclusion. If you move this to 1.74, it's even higher. So higher cost of equity is likely to correspond to a higher price to book ratio. A higher price to book ratio. Now, I want you to think about this because it's something which is in the literature. We know growth stocks and we know value stocks. Growth stocks are the ones that the price to book ratios are very high. High price to book ratios is for growth stock, correspond to growth stock. And growth stocks often have higher cost of equity. You see that now? So growth stocks have high cost of equity. Value stocks tend to have a lower cost of equity because of the low price to book ratio. And all is coming from this relationship. We can confirm that when we move it to Societe Generale has price to book of 0.43 times. If we move the price to book rather to a higher price to book, like that of Standard, keeping every other thing constant, the cost of equity rises. Right. Good. Let's move everything back again to that of EcoBank and leave it there for now. So we're going to come up with some few companies. Let's take EcoBank, Access, and Societe for a moment and look at something. And then I'll pick Republic Bank as well from here. So these are the banks I want to pick. Then let me close here. All right. So these are the banks and the ticker symbols. Let me pick the ticker symbols. I place them here. And the last ticker symbol, which is that of Republic, that's also picked and place here. Now, the price to book multiples, let me pick them also. Let me drag it up to this one and go pick the Republic Bank as well. Now, so then the first quarter, second quarter, and all that, we discussed it already. The other day, I showed you how these things are calculated. And yesterday, we put in the formulas already. So that's why I'm rushing to this side. We put in the formulas. So we have the first quartile. You see the first quartile, you put 1 here. And then we have second quartile, you put 2 here. And finally, you have third quartile, and then you put a 3 there. So let's see. So first quartile is given as 0.42 times. Of course, you can price GCB at first quartile because GCB is kind of like a better bank, right, than the first quartile bank. And if you put GCB at median, a median to like GCB being priced at median doesn't make much sense, right? If you put GCB at third quartile, that is around 0.50, maybe something that will make sense. So we can be moving with something like this. But just a moment. Let's check other things. We come here and we want to commence the valuation. So let me delete this. Let me shift this up. Okay. Now, so we need the book values of GCB, and the book values of GCB as at the valuation dates. We have it like this. So the book values are common across. The next thing we need comparable multiples. which we've computed. So the multiples, we have the first quartile, then we have in the second quartile here, which is the median, and the third quartile, which is the same as the 75th percentile. So we have this here. Now, and so we have the valuation like this. Then we're looking for GCB's trading market value. The market value of GCB on this particular date, we have it like this, market value of GCB on this particular date, like this. Then we ask a question on, is GCB undervalued? And we have the responses. We have the responses here. Let me just paste this a bit. We have the responses here. Is GCB undervalued? And the response is all no. The GCB is not undervalued. So these are the responses. The GCB is not undervalued. Okay. And you can see clearly the valuation. Oh, sorry, am I saying undervalued? No, I think I didn't put in the formula well. I'm sorry, guys. Let me change. Let me take my words back. I'm saying that if the trading or the GCB's trading market value or the market capitalization is greater than the book, the relative market value that we've just computed, then we will say no. So it's supposed to be no. So otherwise, yes. Or I can still do something like this. And let me explain to you the logic behind what I'm doing. So I'm saying that if the market value is greater than what we have computed, then in that case, we know there's an overvaluation. It means the market value is higher. So there is an overvaluation. The fair price should have been this and it's rather this. If there's an overvaluation, but the question I'm asking is, here I'm putting more of undervaluation. I want to use undervaluation as the decision point. So I want to determine whether the shares are undervalued. And the shares are undervalued if the estimated value here is higher than the market value. And clearly you can see that it's all higher than the market value, right? It's all higher than the market value. Therefore, there is an undervaluation. And the answer or the response here is yes. There's an undervaluation. Okay. Let's do something more. We will do a per share analysis below. Let's do a per share analysis. So here I want to do per share analysis. So I want to do per share analysis, and I'm going to have relative value, or market value, relative market value, and then trading value, right? The trading value, and here then I'll do the analysis on a per share basis below this, and I'm going to have, let me bring this down a bit. So I'm going to have here, a moment, deleting this. I'm going to have, let me bring this also down once. So here I'm going to have the relative market value per share, and then I will also have the relative market value. Maybe let me put it here, per share, and also have share price. Or another way I can put this, I can say estimated share price, and the one below I can say market share price. Okay. Or trading share price or something. Yeah. So I would tend to take off this, and then I'll have here rather number of shares outstanding. Okay. I think there's something in the chart. Let me check. Why don't we write the formula said that it gives us something like undervalued if market value. Okay, so you want fairly valued if. Okay, let me look at it. Why don't we write the formula said that it gives us something like undervalued if market value is lower than the estimated value, overvalued if market value is greater than estimated value, or fairly valued if market value is equal to. Okay, well, that's a good contribution, Mark Jordan. I think let me look at my stuff again. So if the market value is greater than the relative market value, then we say overvalued. So overvalued, and then the otherwise, let me just go for two options because I may never get a fairly valued and undervalued. Valued and undervalued, and they are here undervalued. And then what am I going to include here? Decision. So good. Now let me just put something like that here. Now, so we have the estimated price as we have it here. We have the number of shares here. Then we have the number of shares. We have the estimated share price and all those kind of stuff here. So let's take it out and see how it looks like. And then below that, I want to have, I know it's undervalued. That is a decision that we can make, but we also want to look at the extent, right? So price difference, or let's say price deviation. So it will tell us the extent of the deviation from the market price, right? Or the fair price deviation. And let me take off these. So I have the overvalued and undervalued all in this way. So I am going to take this and I'll put it here. We know that decision already. This is decision. And we can drag this to this level as we have it. Wonderful, wonderful, wonderful. Now, so we have price deviation, extent of the deviation. And so let's start putting some things here, then we'll come to the price deviation, how we handle the price deviation. Now, so we have the relative market value, that we've computed to be this. And then we have the trading value. Then that is this. Let me see. Okay, so we can drag that, as you always do. The number of shares. The number of shares, let me bring them here. I have it somewhere. GCB shares outstanding, 265,000. The reason why I'm saying 265,000, you get it, because everything here is rounded to the nearest thousand. So 265,000. 265,000. Okay. And then 265,000. So that is same across 265,000. And then we got an estimated share price. Or we can call it relative share price, right? That is this divided by number of shares. And then We also have the trading share price and also this. So we have something like this. You have something like this. Then, so the decision, we always know the decision. Oh, a moment, I think is an error. So let me rather copy this and then bring it here. So this divided by this, or this and this. So undervalued and overvalued. Okay, good. So then from here, the price deviation, we're going to have, so it should have been this price divided by this minus 1. So what is the price deviation here? 1.9. But as we move towards the third quarter and all that, you will see that it increases. It increases across the time. Okay, let me change it to Arial. I like to work in Arial. Okay, so this is what we have now. The price points and here, and we have this here. So guys, so this is what we have as a price deviation and across with the banks that we've just selected. Right. Any questions so far? So we've set our market multiple model also, and we got it right. This is something we have. Actually, we got it right. For now, one thing we're going to do, you can see when we put it around the third quarter, about 20% decline, 20%, right? We're going to go back and do some work. But before then, I want to duplicate this and do something for us to see. Let's do a summary of all our valuation. Let's do a summary. So valuation summary. So for a valuation summary, we are going to, I want to delete every other thing. We have this deleted. And then I have all this also deleted. We're going to do a summary of our valuation and call this valuation summary. And valuation summary we have here. So what we're going to do is that we're going to provide a summary of the valuation we've done. And this is where, this is where the whole work starts with what we want to do for today. The whole work starts from here. Okay. Give me a minute, just a minute to quickly check something. Just a minute. Guys, a moment, please.
As a business owner,
I want to
having
use
the
a certain
CFA
link.
charter
Just
gave me
looking at
both the
something
confidence
quickly.
and also the
Bringing that
credibility,
in.
which was
Check
recognized by
something.
both my peers and also by my clients. My name is Ariel Jacobs Fatoni. I am a CFA charter holder and a certified financial planner. I am an entrepreneur, a wife, and also a mother. I run Good Balance Financial Planning, a fee-only registered investment advisory firm serving professional women and couples in the Los Angeles area. My career has taken a winding path. I began my career as a financial economic litigation consultant, and in the aftermath of the 9/11 attacks, I transitioned into the mortgage industry and ultimately became a senior structurer where I was actively involved in creating mortgage-backed securities. The financial crisis of 2008 caused me to pivot into the municipal space where I was an institutional salesperson. After becoming a mother and having some time to reflect on my journey, I decided to transition into management where I am today. I discovered the CFA program while I was working in the mortgage industry. I was very excited
guys,
to
let's
learn.
check something quickly. Now, so we have the valuation summary here. And this is how we're going to do. We are going to summarize the values, or we can say estimate, or maybe consider this as model estimates. The model estimate. So we are going to have the free cash flow to equity here. We have the residual income model. And then we have the last one, which is multiples, or price to book multiple, price to book multiples and models here. Then estimated share price, actually, we put that here. So let's look at some few things we're going to be putting. So estimated share price, maybe let's see estimated, right? Estimated or estimate, I don't know. Then let's say current share price or trading price here as well. So we have the trading price, we have the estimated price. Maybe let's do that here. Estimated price and trading price. Maybe let me put these here and then send this a bit. Then the trading price. Okay, good. And I have this also here. And the trading price. So then, of course, we will have the decision point here as well, but I'm even thinking about something. Maybe currently, let me take up the trading price here. Let me show you something first before we bring the trading price somewhere else. Okay. Now let's check something quickly. Let's try to bring the estimate we have here. But you also notice that the estimate we have here for the residual income, we have a single estimate and all that. But when it comes to price to book, we tend to look at them depending on whether we are going for a median or whatever. Free cash flow to equity, let's go and bring the estimate we had, and which should be the adjusted value, adjusted for liquidity, right? And that's what we're going to be taking book value of equity. So this was adjusted for liquidity. We take that there, and then and don't forget, this is not per share, okay? And then for residual income, we go there and pick that as well, intrinsic value adjusted for liquidity. And since we are using the market multiples, we don't need to make adjustment for liquidity again. So we go and pick, but which one are we picking? Let's pick the more likely. Of course, the more likely one is the third quarter, right? Given that that's the most likely, given that the GCP is a bigger bank, right? And so the relative value we estimated here is 2.024. So we bring that also here based on the market. But we are actually not trying to say that the price to book ratio is the most accurate or residual income model or FCFE model. Nothing like that more. even before we bring this one, let's put something here. Let's remind ourselves on the valuation date. So the valuation date is 31. 31. Let me put this one right. 31 December 2024. That's the valuation date we are using. Let us not forget about this. So this is what we have. And this is in thousands of Ghana cedi. So we have this output in this way. Now, the next thing we're going to do is to, just by it here, we're going to maybe apportion some weight. The weight will determine the confidence we have in the methodology we are using. And then, based on the weight, you have the weighted price. So the weight we are going to allocate will depend on the confidence we have in the models. Now, we're going to do something quick first. Maybe let's put, for now, 20% on this methodology. Just now, we just put in something here. Maybe here, let's put 50% on the residual and put 30%. The weight must all add up to unity or 100%. And so, based on the weight, we can come out with the price. So the estimated price and the weight, and in this order. We'll come back to how we allocate this weight. We'll come back to this soon. Okay. Now, so based on this, we can get a price. We can call this actually the consolidated price estimate. We can call this the consolidated price estimate. And the consolidated price estimate, in this case, will be the sum of everything we have above. Be the sum of everything we have. And so this is the consolidated price estimate, the sum of everything we have. So these will be an estimate of the value of the bank. Since this, let's call this rather the price, estimated market value. Let's weighted market value. Now, and this is consolidated market value. Okay. Now, this is what we have. So these are the model estimates, and we're able to come out with some things like this. So we need, the weight allocated, we allocated weight multiplied so that we can come up with an estimated price, which we can call the fair price. And that forms the basis for our investment thesis, right? And so the market value, of course, then becomes the fair price we've estimated. Okay, so I'm going to copy this again below, and we are going to do something. We call this fair price, or we can just call it price analysis. And with the price analysis, we are no more going to be talking about the various model prices. What we are going to do in this case will be to look at the fair price estimated, and then we'll look at the market price, okay, the fair price, the market price, and then we'll look at the upside potential, and then maybe price difference first, and here, the price difference earlier, I used it to be the percentage one, but now I'm going to change things a bit. The price difference here, then here I'll talk about the upside potential. And this upside potential is going to be, is maybe before even upside potential, and before the price difference, we can talk about a decision, and then we can determine the upside potential. I'm going to put something here. I will say, I'm going to call this upside because I expect that the price we are estimating now will be more than if it is downside, then I'm in trouble. So maybe for now, let me leave things this way. But let me just say I'm confident that I'm going to get upside. So I can call this upside potential, right? This will be the percentage, right? So we can look at that. Maybe percentage. We can do more percentages now. Yeah, to see the percentage of upside that we are likely to have. Another thing we can do is that we can look at the price difference before we even talk about the upside. But let's just forget about the price difference, which should, in this case, I want to express it in cities, but we can forget about that now and just talk about the upside potential the way it is. So the fair price, Ghana cedis, and then here I want to also look at the price book. That's the price book. I want to look at that as well. Then I want to delete this side. I want to look at the price book as well, based on the fair price. So the fair price here will be based on, maybe here, let me bring the number of shares again, number of shares back here again. I can go bring the number of shares from where I have the multiples. We have the number of shares somewhere. Let me just pick one of them, number of shares. So this is the number of shares we have. And so the fair price will be the consolidated market value divided by number of shares, and this will give us the fair price as we have. We are not done, guys. Don't think this is a correct price to say. Then the price to book ratio for the fair price will be to take the fair price divided by the market or the book value of equity. And the book value of equity, we can pick any one of them here. And that gives us this as the price to book, as you can see. Now, market price, we had a market price. We go to the price multiple. We have the trading market price. We divide it by the number of shares. That one, we can come to the valuation summary, divided by number of shares, and that gives us this as the market price. And then the price to book ratio, based on the market price, of course, we can compute that here. We have the market price, we having also the book value. So we able to get what the market is saying, and this is what the market is saying. And the next, so maybe with this, I can use a custom. I have already done some. Let me just do that here. Format this and S. So I have this here. Now, so the decision as to whether it's under valuation or over valuation, I have some formulas here. Let me just do that quickly. Pick it up and dump it here. And what I'm going to do is that I'm going to move this here, and then I'm going to move this here. So this is under valuation or stock. The potential upside that we are going to gain will be the fair price divided by the market price minus 1. And so the upside is over 300%. Now, so we put all these in the box. Then, now that we have all this done, we have how we will come up with this and all that. And this is the base case. We're still working with the base case. Now that we have all this sorted out, can we now go and make adjustment to our assumptions? And then we come back to tell the rest of the story. So everything is fully linked, and now we can come back to our assumptions. and go back to assumptions, and then you look at that and then come back to what we are doing here, and then conclude it. And quickly we'll do some simulation, and then we conclude for the day. Okay, now to do this, what are we going to do first? Number one, we need to work on our cost of equity and complete it. We have the size premium and company specific risk premium that we are here to deal with. Let's talk about size premium, GCB Bank. Now, the cost of equity here that we calculated is cost of equity for diversified investment in emerging markets. The diversified investment in emerging markets. Investment, let me just write it in emerging markets. So if we have a diversified investment in emerging market, that's cost of equity. Now, we are going to make a simple assumption that whosoever is buying GCB stocks is a diversified portfolio manager, or the portfolio manager is holding a portfolio that is well diversified. If the portfolio manager is holding a portfolio that is well diversified, then we can conclude on some few things. If it's holding a portfolio that is well diversified, it wouldn't really care much about the risks associated with GCB alone, because of course the portfolio is already diversified. So including GCB too will have a diversified position. Now, but most portfolios in our market here is not well diversified. So there is still some size premium that must be factored in here to take away those and idiosyncratic risk premiums and all that have to be considered. Now, so size premium. Now, I provided some guidance earlier on how you can estimate size premium by looking at the yields on the indices, a large cap stock index and a small cap stock index. And also, oftentimes, I think PwC have been issuing a report on risk premium across various markets. If you look at some of these things, some of these things, you prefer to maybe just give some estimates, like some heuristic estimates, rather than maybe something which is backed by data or something, right, to give that size premium. One thing I want us to know is that when we're dealing with the multiples, and we started to, or try to even decompose some of the like cost of equity incorporated or pricing by the market, we're having something really high, right? I want to also tell you that when we come to the cost of equity here, I want to tell you that the cost of equity we've calculated here, those companies used in the US upon which these things are calculated, they are large companies, right? We are talking about companies in the S&P 500. They are quite large companies, of course. So GCB cannot be compared to any of these companies in the S&P. In fact, no company in Ghana can be considered or compared to any of the companies in the S&P. We know GCB is a large bank, is one of the largest banks in the country, but still some premium is necessary for the purpose of size. You can also say, but another argument, of course, which you can also make is that this is a big to fail bank. So, of course, why would you be attributing high premiums to it, right? But of course, there's still a need for some premium. Now, I want us to start with something. Let's try to get maybe a 5% premium added to this. Let's take a 5% position and check something. Now, when it comes to company-specific risks, it's a matter of comparing multiple factors to see what should be the ideal discount rate. Maybe we can rather make the size premium, let's say some 3%, and just say the company-specific risk premium will center on a lot of things on the balance sheet of the or things specific to the bank. The fact that we have government influence on the bank is a key thing, and the government being the largest shareholder is something which will be concerning to a lot of investors, right? Given that government is the largest shareholder, a lot of investors will be concerned about government taking ownership and controlling how things are going as far as the bank is concerned. Non-performing loans, not quite a big deal for the bank. The bank is doing quite well. If you look at GCB, it's one of the well-managed banks in the country, we can say. It's not a bank that you'll be thinking about, oh, come on, this bank could fail and it will create a problem for us. No, not really. they bounce back seriously. If you look at the P&L, they've been doing well. The profitability has been growing each year. They're making profit, in the exception of the DDP year 2022, when they make a significant loss. And by the following year, they bounce back strongly, 994 million, and then this last year they make 1.2 billion. And if you just imagine where the bank is going to now, you realize that this is a very great bank, right? So the company specific risk, apart from government interference and in some of these things, which of course you consider as a big issue, the fact that government interferes into the board selection and all that, not really much big matters to be associated with a bank. But of course, let's say we want to put the size premium something around, or company specific risk premium around 5% to start with. Let's check how things are going to look like around that. And so if we put the cost of equity around 35%, which is almost close to where the market multiples are. But a better way to estimating them or doing this work, if I'm actually to do this for a client in maybe, it will take me a time. Of course, don't forget we are doing this within 2 hours, so we are being timed. You do more work, and those are part of the note I shared with you some time ago. So 35.79. Let's see what our models are giving us based on that. Free cash flow to equity model has reduced drastically with a justified price to book of 2.81 and after liquidity discount of 2.53. If you look at the RRI model, it's giving you a justified price to book ratio of 1.16 after liquidity discount of 1.04. Now, when we go to the multiples, the justified price to book multiple now for GCB is around 0.95. Around 0.95. That's justified by the fundamentals that we saw as it is here. Now, that is the first step in the adjustment. Coming to the price analysis here, you are looking at a fair price of about 1.18 based on the weighting we have given to this, 1.18. And then there is one more thing I wanted to check here. Okay, so I want us also to check the market price. The market price as at yesterday, right? Let's say end of March. So at 31 or end of April. So 31 April. Am I saying 31 April? 30th April 2025. Let's look at the market price around that time. So when I get to the exchange, I'm not sharing the screen. I just want to get the price at the end. That's 7.4. So let me bring that here. 7.4. I want us to see the realized upside already, because we are valuing the bank. We are valuing the bank as at 31 December 2024. So as at 31 March, okay, as at 31 April, sorry, 30th April, this is the price. The price is 7.4. So we want to get a realized upside. What's the realized upside here? The realized upside is the market price at this point divided by the market price as at 31st December. And then we subtract 1. So the realized upside is about 16%. That's the upside realized. And then we can also calculate the unrealized upside. So the unrealized upside, in this case, will be the fair price we estimated divided by the market price as at the end of April, then minus 1. So the unrealized upside is 143%. But look, we've not yet concluded on these figures, this estimate. So let us not be carried away by them. So this is the market price as of April. And this price analysis was based on a price or maybe valuation date of 31st December. Good. Now, let's work on some few things. Let's go back to our objectives. We have an objective here, and what are the key things we are looking at? We are looking at the return on equity of the bank. And the return on equity we forecasted for the bank, the return on equity, I mean the return on equity based on profit after tax had been 26, 23, 29, then it dropped in the DDP period, then 42, 35. The one we forecasting are all more than 33. But let us not forget that the bank may not continue to sustain this high return on equity over a longer period of time. That may not be sustainable. Now, let's look also at the return on asset. Return on asset have been 35 or 3.5, 3.2, 4, 4.1, 3.5. In fact, historically, the average return on assets had been these, let's say these, the average return on asset has been 3.5, but we are forecasting a return on assets averaging around about 4.7. That may be too high. Not that may be too high. That's quite high from a base case perspective. That's quite high. So we need to make some adjustment. Even come down here. So you are never done with your financial model. You always get back again, right? You want to ensure that the figures you are using are as reasonable as possible, right? Now, let's go to the yields we are projecting for the assets. So, of course, we have the average yield here, or let's look at net interest margin here, and is ranging between 11% and 14%. And the forecast is also ranging between the same thing, the same region. And I don't think it's bad at all, because but there is something I wanted to note. In 2019, what is the average yield on assets? 15%. In 2020, it's shot to 20%, right? We have been forecasting 19, 18, 18, 18. Currently, interest rate is high. And that is true. Interest rate is high. So I don't want to care about period beyond 2021 because those are high interest rate periods, right? At a point in 2019, the yield has been 15. So it makes sense to keep things between 20%, whatever. So I think this is fine. This makes some sense. The yields are making some sense. And by extension, the net interest margin is also reasonable. So I don't think it's something I want to check on. Maybe what I would like to check would have been the growth rate in deposit and the growth rate in loans. So let's check that up and see. Growth in customer deposits, 21% in 2020, 16 in 2021, 33 here, and 23 and 58. You see that the growth has been a bit funny, right? It's, 2024, sometimes I have a struggle with this sometimes when I speak to the senior people at the bank, at GCB. I tend to tell them that, well, I don't think the growth they're estimating they can get to that end of the day, the following year, they end up even achieving that growth. Look at the growth with 58%. But will you say that going forward, they're going to repeat this trend? Yes, maybe not. Okay, but for valuation purpose, we want to be a bit conservative. Our projected rate growth in this manner, or the growth in the loan or deposit in this manner, maybe we will have to check it again. We can grow in between. If you look at a minimum and max here, 16 and 58. So one argument I tend to have with the bank officers is that you have 58% growth in 2024. Do you think you are going to do that by a multiple of 1.3 the following year? And that's a scenario I'm seeing here, kind of like shooting myself, right? I want to move the growth in between to swing in between, let's say 21% and 25%. Or maybe we can do something like 23% to 26%. something may be more conservative around that, 23% to 26%, or or to 28%, something like that. It's showing the C30 going forward. We can do something around that. Next thing is growth in loans. The growth in loans, historically, I've not taken a very good pattern, but the rate at which I projected this to be growing at this consistent rate is a bit alarming. Yeah, we can do a 30%, whatever, but we can keep the growth between 25 and 30% and keep the deposit growth to maybe deposit growth between 23 and maybe 26%. So let's check that out and then get back. So we're going to base case model and want to check some few things there. Base case model, funding. So what am I doing? I have to go to base case assumption, sorry. So the base case assumption, savings account, current account. So we want to keep things for deposits between 23 and 26, 23 and 26%. So what do we do? But if you look at some of the deposits, they are growing at a faster rate. Of course, if you look at something like the current accounts and all that, right? So I'm going to do something here. I'm going to go here to the objective, and I'm going to move the growth in deposits. I'll bring it here so I can be looking at whatsoever I'm doing and seeing if I'm achieving my objective. Okay, so let's check it out and see. The 36% the first year and 26% in the first year here to make a bit of sense to me, but for time deposit, I may want to reduce this a bit to maybe 10% in the first year, and then coming to the second year, I want to do this reduction to 30% growth, and here to 22% growth, and this put is at 25, and here to 30%. And in this case, this is more appropriate for me. Something like this make more sense. This growth pattern makes more sense, right? If you check it out, it makes more sense. Now, let me do for the loans as well. So I go to gross loans. Let me put the loan growth below that objective. So growth in loans. Let's see how that one can also be adjusted, guys. So we have 35% here, then overdraft 45%. Let's make the overdraft 30% for a moment and see something. And then a growth in loan itself, we can make 30% this year. And we don't want to raise it. It was initially 36. We don't want to raise it above 30. Then 30% going forward. Let me check my profits and loss account to see the distraction going on there. Yeah, this is not too bad, but you can see that we moved from 1.2 to 1.5, which is a good move in 2026. But 2.4 to 2.4 million is quite a huge jump, right? So if you check what is actually driving this, we have profits, we have the net interest margin driving these by more than 1.something million. And then also the fee and commission must be adjusted as well. Net traded income doesn't increase that much historically, so we adjust it a bit. But the key adjustment to pass is going to be associated with the loans and advances. So I'm going to also look at the balance sheet and look at how the balance sheet is behaving. And on my balance sheet, I'm going to check some few things here. Number one, I want to check cash to deposit ratio. Let me just view it from this side. Cash to deposit ratio and customer deposit. And that is giving me what here? 34%, that is too high for me. 31%, blah, 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 blah. I think my deposit is too high and compared to the loan growth I'm forecasting. So I'm going to go back to my objective, the base case objective. And what I'm going to do here is that I want to bring the cash to deposit ratio, and where I can find here. So let me bring the one here, cash to deposit ratio, and let me put it here. So I want to work on my cash to deposit ratio. So in that case, I may want to reduce my deposit further. I may want to move this to maybe 30% growth in deposit this year. Since in some years the growth can even be 18%, can be 23%, 27%. Of course, people complain that, well, they are recovering, right? So that should be pretty much okay. Yeah. Everybody's recovering. If I say recovery, I mean the economy is recovering, right? And this I can put it at 24%, and then 22, then going forward, or maybe I can even do 22% drop in deposit because of the huge growth in the previous year. This is not too bad now. I can check the other variables like the loan to deposit ratio, and which is this one here. Let me check how it's looking like. Loan to deposit ratio is not bad. I think it's something which I'm comfortable with. And then what else? That's loan to deposit ratio. What else? I must be interested in. So when I go to my P&L account again, I see 1.5, then to 2.4, then to 3.5, then to 5.1. You see, the growth is just getting crazier and crazier. If I look at the historical growth in, let's say, the net interest income, the historical growth in the net interest income, I'm having this. Oh, what am I doing? I'm putting in the wrong parameters, guys. Over a 5-year period, and the present value being this, future value being this, I want to see, it's giving 23%. And if I do the same for the forecast period, so this is same 5-year period, opening balance is this 2024, then the future value is this. It gave me 32%. So I think this is on the high side. Now, one thing we can do is this. When we look to the P&L matters, the yields on the loans have been, investment securities have been constant, and that's maybe too bad. Historically, it has even reached 13%, and the rate will fall. So 16, maybe let me make this around 15, then maybe I can do 14.5, and then maybe I can do 14 throughout. And then when it comes to short-term funds, that is also dropping. So I can make these 25 to be in the last year's rate, 25. Let me check something. Last year rate of 25, and then reduce these to, let's say, 20, or maybe even 18. Even this 25 for 2025 is too high. Maybe we can put something around average of 90 by the end of the year, maybe 20. And then we can do something around maybe 18. I still expect that short-term rates are still going to be high. And then, but these rates at 18, we can keep at 18 to see or think about the recovery in economy. Or maybe just for a safer side, we can do like 22 and then keep the rest at 18 throughout. And the loans yield, how I put it also make a bit of sense to see that interest rates are dropping, and so the average will be around this level. That is not too bad to say. If I go to the profit and loss account, I'm having this picture 1.5 to 2. That makes a sense. That's about 500,000 different, 500 million difference. And then this to 2.9, then from 2.9 to 4, from 4 then to 6. Now, let's go back to the base case assumption. There's a few things I want to work on again. If we look at the loan growth, we have 30% throughout. That may not be happening at 30% throughout. Maybe the first year 30%, second year 30%. We can reduce that over time at 25%. And then we can also look at the overdraft. Overdraft 30, 30, 30. Overdraft has really been erratic, right? The growth, we can keep it at a 30 as it is now. And staff loan growing at 14% may be too high. Maybe we can make it at 10%. Because some years it even declined. So we can do 10% throughout, and maybe that should be fine. Now, so going back to our profit and loss account again, 1.5 to 2, 2.9. Let's see where most of the things are coming from. Now you can see the CAGR in the net interest income versus the one for the forecast. Of course, versus the one for the forecast. You see that there is some maybe closeness. One thing we will need to also cover has to do with the issues of the fee and commission income growth. Now, historically, the fee and commission income has grown in this fashion. Let's look at it. Fee and commission income. So historically, and this side to fee and commission income. Let's put it here. Fee and commission income, net fee and commission income, net fee and commission income. So it has been 26% versus a 32% here, right? 26% versus a 32% here. The growth may just be too high. Let's study that and see. If we move to the objectives, we're going to have the non-funded income to total income ratio, non-funded income to total income ratio over a forecast period is this that we're seeing. 21, 32, 25, 27, and 28. And that is not really different from what we see historically, just that it's a bit on the upside, right? And so we need to do some revision. So I'm going back to the assumption, base case assumption, and I'm looking at the assumption regarding the revenue. I think there's a question. Hi, Julia. So in this instance, don't people pay economists to conduct reliable research for the next few years that will help them in the assumption use, where they will have probabilities in a particular economic outcome? How is it done in practice? Oh, definitely. That's the reason why a lot of investment banks have economics department. They provide this, and the banks also have economics department. So you are spot on. That is exactly how it is. That's why they have economics department to handle these things and also provide some services outside. All right. So the growth rate we have here for the non-funded income may just be too high, right? Let's say we keep 2025 at a 22.7. And then maybe for over a future period, we keep it at 22.7. Let it just grow at 22.7. Let's see how it looks like. So as it grows at 22.7, the objective we have is this, and this is good. This is good. Compare this to what we have. Compare this here to what we have historically. That makes a lot of sense. Now, coming to the profit and loss account, look at what we have now. Profits of 1.5 to 1.9. That's about 400, whatever. Then 2.6. Then 3 points. So the differentials is quite good. If you look at the profit growth, let's check that also out. The growth in profit after tax. So if I bring a profit after tax, And this also brought to profit after tax. Let's see, 22% historically. Let's check the forecast period, profit after tax. So we bring this to the forecast period, 29%, 22% versus 29%. Now, even though is too high, is good. The growth rate is good. If you look at the fee and commission income now, the growth rate is smooth and is very, very good. And maybe one thing of concern, maybe the net trading income, but that is also not too bad. The net trading income too is it's not looking bad. It's not looking bad at all. It's not looking bad at all. Of course, the growth we have predicted in the net trade, the non-funded income is just in place, and it's fantastic, right? Personal expenses and all that too are growing really well. So we're having a better financial statement than before. So the SPL is looking really good, and I think it's something that we can really work with. Now we just have to check whether other items on the balance sheet are looking or are making sense. So let's check that quickly. Objectives. So on the objective side of balance sheets, the balance sheet here side, we tend to have, even before that, if we look at the net interest margin is also good. It's actually lower than history. But it's good. The bank is growing, right? Loan to deposit ratio is not bad at all. It's good, right? Then if we look at cash to deposit ratio, is in between 30 and 20, which I'm comfortable with. And then return on equity is this. Oh, wow. Look at this return on equity. Let me just compute something for you to see. If I take the average return on equity, and this is this, comma this as well into the average, we're having 3.7. Let me do the same calculation here for you to see. Am I saying return on equity? This is return on assets. I'm sorry. Return on assets. 3.4. It's even lower. Yeah, so it's more conservative work we're doing, right? The work we're doing is more conservative. When we look at it for the equities, the return on equity, we have average of 31% in the past. For the forecast, we have about 32%. Oh my goodness. I think that is what I'm looking for. So our model is good. Now let's go back to what we've been doing. Free cash flow to equity is now putting the bank at 1.69 liquidity before liquidity discount, and after liquidity discounts of 1.52. Residual income is putting a bank at before liquidity discount of 0.8 and after liquidity discount of 0.72. Now, then one thing we can do also is that, I've placed the cost of equity at 35.8. If I reduce the additional premium that I add to this side, if I take off the entire 5%, remember it is 3 and 5. If I take off the entire of that, I'm still having something not too bad. But of course, we need to bring those specific premiums. Now, one thing you should know, yesterday, the sustainable return on equity, we were using 25%. That's a sustainable return on equity. But the way we calculated the return on equity as per the residual income model is different from the way we do it for reporting purpose, right? As per the residual income model, we have a return on equity of this. In fact, the cost of equity is still higher than the return on equity, which explains why, the cost of equity is lower than return on equity. In fact, it should have been explaining why banks or the company will be trading below 1. But because the return on equity is higher than the cost of equity, in the residual income model, the bank must trade above 1. So you could see, let's check that. You could see that it should have traded above 1. Let's check it out. A moment. We see the return on equity greater than the cost of equity. So technically, the bank should be trading above 1. But the bank here is not trading above 1. And let's check what could be the reason. Check the formula for the terminal value. Terminal value, the sustainable return on equity there is lower than is lower than the sustainable return on equity is lower than the cost of equity, and that's 25% versus the cost of equity of 35%. And that's the reason why we have this huge negative here. That's one thing I wanted to note. So when we're calculating that, the terminal value, how did we do? We took the I-17, which is the book value here, and then we multiplied it by the sustainable return on equity minus the cost of equity, and that gives us a negative residual income. And we divided it by 1 plus the cost of equity, and then minus the persistence factor. And that is just to say that the residual income will not persist going forward, right? But then there is something fishy about this whole formula. Am I saying will not persist going? This will mean that the residual income, what we've calculated here, guys, let me take back my words. Because the persistence factor is 1, we are saying that the residual income will persist for a long period, will continue to be, or will persist. So given that the cost of equity is greater than the return on equity, the sustainable return on equity we are using here, there will be a negative residual income, and that is going to persist forever. But we don't think this is accurate at all. This is what we can rather do. The sustainable residual in our cost of the sustainable ROE, as we have here, I believe this sustainable ROE should be greater than 20, a little greater than 25%. But to also see that the bank is the largest bank, over time, we should see this thing trailing down below 30. And the risks in the financial market, we cannot be banking on high return on equity. So putting it at 25% also is a bit justified. Good. Now, so we say there's a high risk because it's a government bank, so there's a high risk. Beyond the explicit forecast period, we can assume that things may not be as we may really expect, right? So this is what we're going to do. We will continue to use the 25%, but we're not going to use a persistence factor of 1. Because if we use that, it means the negative residual income will continue. But we don't think so. We think at a point, this is going to wipe away. If we put it at 0.5, we have this improving, okay, and the negative reducing. But this is a big bank. This is a bank that is doing quite well. So 0.52 is not making much sense. Maybe 0.3 will do. Let's look at 0.3. And this is where it takes us to. We are saying that the bank is already doing well. So to say that there will be negative residual income, the probability is quite low. So for me to even do this, I'll always want to put it at 25% and I'm set. So this is where I reach. I put it at 25% residual income, a persistence factor for a negative. And I set this at this level. When I go back to my free cash flow to equity model, it is giving me this value. And when I come to, and of course, there's not much to do, but we're talking about some due diligence to be done. We've not really found anything. And when you're doing this in practice, you tend to see whether there will be additional adjustment to be made. And that may reduce the value further. So after putting all these things in, we go back to the valuation summary. And this is what we have in the valuation summary. So we have the weight in this order, and now we're going to work on the weight. The question is, what faith do I have? I don't have great faith in the current state of the market. I tend to have greater faith in the residual income model than in the FCFE model. Residual income model is giving me, and maybe based on liquidity stuff, of 0.87. And the market is saying that we are pricing these, let's say if we price at the third quarter at 0.5 times. But residual income says, well, it should be 0.97, 0.87. Now, which one am I going for? I have greater faith on residual income. I'll tend to place the market at the 30 I'll tend to place these rather at 60, and I'll tend to place the FCF model at 10, because I have more faith. Of course, I know the book value of the bank today. So I tend to see the residual income as giving me something of value than what the other ones are giving me. So I'm looking at a bank and I'm trying to do something around this. And I am coming up with something like this, which I think make a very good sense. Now, of course, there are views you can express on some of these things. Of course, you can do the computation and see what you also be getting based on assumptions you want to run. And in fact, even if you do, if you proceed to, let's say, check, this is the base case I've done. If you proceed to check, let's say, instead of the base case, you want to do maybe the best case and all that. Let's see that. If I put it on a worst case scenario, let's see where the worst case scenario will take us to. The worst case scenario will be really bad, right? But let's see where it's taking the bank to. The worst case scenario is rather saying that there's a downside. Eh? He said it's overvalued. Worst case scenario is saying that your bank is overvalued. That's what the worst case scenario is doing. It's giving us a fair price of 0.36. And of course, even in the worst case scenario, see FCFE, see where FCFE is, and see where residual income model is. And look at, and so if we rather put it, instead of the worst case scenario, if we move this to, let's say, the best case scenario, let's see how it is. In fact, some of these things, I think I should just copy the formula rather and paste it here, so I can be doing the controlling from here. I can be controlling things rather from here. And I mentioned that to you some time ago, that's what I'm going to be doing later. I'd rather control things from here. Let me go to data and go to data validation, so I can clear it from here. Clear validation. Oh, sorry, I didn't do the right thing. Data validation. Then I clear all. Okay. So I'll rather come and link this from here. Valuation summary. I'll link it from here. Now, so from valuation summary, I can now be doing my drop down. So currently we are currently on the best case scenario. And see best case scenario. Look at unrealized upside that we have here. And then and if I move to the worst case scenario, I can drop down to worst case scenario. Worst case scenario, and let's look at the unrealized upside. It's rather even a downside, right? That's what we are having here. And we can move this to now our base case, which we are interested in, which is giving us an unrealized upside of 70%. Guys, so here is it. And then the next question will be about when do we think this convergence will happen? How long do we think will take for the convergence will happen? The question of the time will take for convergence to happen requires a deep knowledge of the market dynamics, especially also the stock in question. Because the stock in question, if you're following it over a long period, for example, let's check this. I'm taking you back to the stock market and check the market. And let's look at this over this 1 year period. Let's look at this all. GCB, maybe let me do a 1 year period. Look at where the market was, okay, in May 2024 was 4.22. See how it just increased ever since. Let me even change it to 2023. So we start seeing it from 2023. Look at 2023. This is June, or this is May 2023, 2 years ago. It was 3.19. 3.19. I wanted to check something. 3.19. Look at it now here. 3.19 to 7.6. 3.19 to 7.6. Let's do the calculation. 3.19 to 7.6. So 3.19 to 7.6. Let's see the growth over a 2-year period. Have you seen this? 138% movement in the stock over a 2-year period. What I'm predicting is an upside of 98%. And I expect this correction to happen. Of course, this could happen, the price moving towards the target within a speed of a span of 2 years. This should be consistent, given the market is working well and the macroeconomic environment is as stable as it is now, and there's confidence in the market. We expect something, the convergence, to happen really quick. Good. That being said, let me see what I've done so far. So we have the price estimated, fair price, to be 12.59 for GCB, and the market price is the market price asset. Let's see. I want to be putting these things in so that this December 2024, right? So that people don't hold me, wrongly. Market price then in April 30th was 7.4, and then I expect the price to be 15.59. So that's the price I expect based on the workings I've done. All right, good. Let's see what we have done so far. Going back to the multiples, we say we conclude on the value estimate for GCB. We have done that. We have done that now. The second one, we say we simulate possible prices for at various stages in the future. We've not done that yet. We determine price targets. We've done that. We've concluded on the value and individual value. Then we determine the price target. That's what we applied the percentages in order to get a price target, which we have done. This one wouldn't be too big to do. So let's pick the simulation first. Great. We have about 30 minutes to go, and we're going to run some simulations. Hello, guys. Are you guys here? Let me put it on the valuation. Tell me, what are your comments? Let me get some 1 or 2 comments from you. Let's do this within the next 5 minutes. Let me get some few comments from you on what we have been doing so far, and then we proceed to the next things we want to do. And tell me if you have been enjoying this. Tell me if you have been enjoying this as well. I want to hear that as well from you. Taking this. I want to show you something now. We'll do the simulation because I need to complete this today, right? I want to sleep knowing that I am more than a conqueror as far as this is concerned. I'm checking out something quickly, guys. I'll get back to the comments you're putting there just in 1 minute. Then you see on this issue of Monte Carlo, I'll be doing a webinar later myself, and I'll have some things to say about Monte Carlo simulation. And what we are coming to do here, we are just going to be doing something simple, right? I just going to bring the methodology, and then I'll show you how we can apply the Monte Carlo method to solving the problem we are faced with here. It's not to make you become a master of that. If to become a master of that, of course, you need much more work than this. And Monte Carlo is actually that methodology or that approach that is used to solve for option prices and all that. The very complex options are often priced using Monte Carlo. I think this is lesson 13. I want to get it less than 14 or something like that. Yeah. Okay. So it has great utility, right? We will use it for simulation. But I'm just going to start from a point. So I'm going to do a number of talk, a lot of talking first before we do it. Then we go to the Excel and implement in the Excel. The implementation in Excel is the most important thing to me, which we'll do before we close. That's what I told you today. You prepare, right? And I'm prepared to do this. So I hope you're also prepared. Let me see the information, the chart. See what's happening. Great. I'm here, pa, not moving an inch. Nelson, I like that. Yes, of course. The upside is huge. Perhaps some free lunch there. I tell you, I love it. And if you look at it, guys, look, Mike Jordan, you agree with me that the assumptions we are using for this forecast are quite conservative. The assumptions are conservative. Even if you look at the company-specific risks and all that, they are all very conservative assumptions we use. They're on the high side. The cost of equity is on the high side, but still we are getting something of great relevance. I do see upside potential, but nobody willing to take too much risks in equities. Side dynamics in our market. Hopefully, the Gen Zs will take over the markets soon, and we will see fire. Well, that is what we are all expecting, right? We want to see that fire happening. Now let's talk about something interesting. Hey guys, just a moment. Let me grab water, right? A moment. All right, I'm back. Good. Can you see my PowerPoint? Quickly, can you see my PowerPoint, please? Let me see something in the chat to show you can see my PowerPoint. Okay, good. Let's take it. Now, you see, I have written a paper on Monte Carlo, how Monte Carlo simulation can be used to value businesses when I was with KPMG. I think that was in 2023 that I wrote that paper, the application of Monte Carlo simulation for business valuation. And I showed how the geometric Brownian motion can be solved and the solution used to price businesses. And I take the final, I came up with a financial model, which is often the free cash flow to equity model, which I use. I use that free cash to equity model as a random variable, the cash flow as a random variable, underlying the geometric Brownian motion. How many of you have ever heard of geometric Brownian motion before? Let me see by hand. Though, if you have not heard about it, just say no. Let me see the yes and the no's. Let me see how it looks like. Geometric Brownian motion. How many of you have seen it before? Geometric Brownian motion. Yes or no? Just put it there. Let me see. See if I say yes. Or is that an old yes? No. Okay. All right. How many of you have ever heard of the Black-Scholes equation before? Or you've seen the Black-Scholes equation before and you know what it is used to do? Not that you can recall it. No. You've seen it before and you know what it's used for. Okay. See if I say yes. The rest? Nelson, go. Okay. Gilsbond said he's never seen the Black-Scholes equation before. Okay. Okay. All right. So you see, let's look at it this way. You see, the people who are into financial engineering or those in quantitative finance, they don't care about financial statement when they are dealing with stocks. They don't care about financial statement. They just care about the stock price. But you see, there are mathematical models that can be used to explain why the stock price behave the way it does. So we can look at the historical data, the stock price data, and based on the data, we can use it to you can use it to predict the future prices. And based on that, we can price options and all those kind of stuff. Right. So the stock price has a process. There's a process underlying the stock price. If I say process, it's a mathematical relationship I want to talk about. So, and of course, the lesson is probabilistic analysis, Monte Carlo. It's just a single lesson, probabilistic analysis. We've done part of the lesson already. I think this should have been lesson 2, right? The lesson 1 had been on the analysis of the valuation result, but this is more of lesson 2, probabilistic analysis, Monte Carlo. So what is happening is that I stated that we saw the stock price follows a process in discrete time. I took this from some lecture I gave, maybe for the purpose of those watching online. Let me change this to we know that the stock price follows a process in discrete time. Okay, so I think I drafted the news myself, so I know where these things are. So this one is going to happen, right? The stock price actually follows a process in discrete time. Now, when we deal with time, we have discrete time and continuous time. Discrete time, or if something is discrete, we can say simply mean it's countable, right? You can count it. 1, 2, 3, 4, 5. That is discrete. Continuous, you're gonna find it difficult to count. The stock price is a continuous variable itself, but it's also a bit considered discrete in a certain way, right? What we're saying is that when we say the stock price follows a process in discrete time, it means that we can actually, there is an equation, which also we call a process, that we can use to forecast the stock price tomorrow. If we know the stock price today, we can determine what to be, or we can predict what to be the distribution of stock price tomorrow. Nobody can actually predict the stock price. So sometimes when I say this, I need to take my words back. What I'm talking about is that you can predict the distribution of the stock price, the probability distribution of the stock price. So if I say if I say you can determine this or predict the stock price, if I use that language, always know that I'm talking about you can predict the probability distribution of the stock price based on a certain process. And this is the process. This is the formula. Because I'm not taking this from the very basics, I know it's going to be a bit difficult for a number of you to understand, but I want to take my time to explain. There are a lot of things I could have explained before coming here. I should have been able to explain uniform distribution, standard normal distribution, log normal distribution, and all that. So a lot of things you're supposed to have understood before coming here. And even how I formulated the discrete time geometric Brownian motion. So the GBM is called geometric Brownian motion. Now, let's look at it this way. I'm going to define some items here. The ST is the stock price at time t. The ST is the stock price at time t. So the mu here is the expected return on the stock price. The mu is the expected return on the stock price. Let's get that. That's the mu, the expected return on stock price. The delta t is the change in the stock price. The delta t is a change in the stock price. The z has a name. And we are going to talk about that. The z, consider it as a random variable, and that's the z-score. You know the z-score? The z is the z-score. is a random variable, and it's going to come from something called the Wiener's process. We're going to see something soon like that. So the Z, exactly, Cephas, you got it right, the Wiener's process. Yeah. The Z is a random variable here. So the randomness in the asset price is not caused by the standard deviation. The randomness in the asset price is caused by the Z. It's caused by the Z. And so what we're saying is that the stock price tomorrow is the stock price today plus a change, plus a certain change. The stock price today, which is as time ST, plus a certain value. And the value is made up of two things. One is the one where we take the stock price, we multiply by the expected return on the stock price times delta T, plus the another side, which is the volatility, which is the sigma, times the Z-score, times the stock price, times the square root of delta T. Now, this should be easy to understand because I explained to you when we started all this work that returns, expected return grow by, it's scaled by time, right? While volatility is scaled by the square root of time. Okay, returns are scaled by time, while volatility is scaled by the square root of time. Now, so you can see that relationship playing out here. Now, sorry, so let's look at this properly. Now, let's explore this process further. Now, when we move this ST to the other side of the equation, you have ST plus delta T, which is almost to say the next day stock price. That's if we consider delta T as daily time step. Okay, the change in time is 1 day. So if we have ST is today, then or day 1, then ST plus delta T should be day 2 because the delta T here is 1 by the illustration I'm giving. Now, so when we move the ST to the other side of the equation, you have ST plus delta T minus ST, and then equal to this. But we know that ST plus delta T, there should have been a T by the delta, minus ST, is the change in the stock price between 2 days, yesterday and today. Or in other words, between day 1 and day 2. That is change in the stock price. Okay, so now we have that called delta S. So the whole ST plus delta T minus ST now simplifies to delta S. And then we still have the right side. Now we can decompose this. A moment, there is something missing here. This a moment. Why am I not able to? Just a moment, please. There is something I've not picked up into this lecture note. Just 1 second, guys. Let me correct that. I have something missing. I don't want to go through everything, so I just selected some specific things so I can talk about them. And in doing so, I mistakenly failed to pick up some few things. And that's what I want to pick up and place there so we don't run the risk of okay. Oh my goodness, I think I picked everything. How's this? Oh, a moment, guys. Okay, I have it now. Let me bring it to our latest slide. Okay, I have it now. Please, can you see? Can you see now? Can you see my screen? Just to confirm. Now, I believe you can. Maybe let me reshare the screen so in case you are not able to see. Okay, good. Now, so we see this, and let's illustrate it. So the delta S is a change in stock price, And this component, the first term to the right, is the drift or the growth component of the stock price. And because the expected return times the change in time times stock price will give us the change in stock price. And this drift is that's kind of like the stock price is giving us the stock price to have that gradual growth, right? That gradual growth without doing that kind of up and down, that kind of volatile trend. It's giving it a smooth trend. Okay, it's a component of the stock price that has an upward trend like that. It's just moving up without taking any curve, right? Then the second part is a random or stochastic component. And this is the one that brings about that up and down movement in the stock price. So if you check this, going back to the website, and if you check this for GCB, you see that overall, the stock price, let me look at it over a 1 year period, the stock price have been moving up, right? Generally, it's moving up. However, maybe this is even not clear. If I go to another exchange, like if I go to the Johannesburg exchange and I pick something like, let's say I pick the Absa Group index for the Absa Group, check what's happening. You see, generally, when viewed over maybe a longer period of time, of course, this one is even not looking good for me. Let me go step back and check. Okay, if you look at the Johannesburg index, okay, GSE index, the all shares index, you see there's a movement here. The index level has been growing, but it's been up and down, up and down, up and down. But generally, it's been growing. That smooth growth, when you look at a trend, that is the first component that I said, a growth component. And what is causing this up and down, up and down, up and down, before over a longer period you start seeing growth, is what we call the stochastic component. So we have the stochastic component here, right? Now, so that is in discrete time. In other words, we have the stock price to today. We can predict what the stock price is tomorrow. When we are in tomorrow, we can predict what it is the following day, then a third day, then a fourth day. In other words, we are predicting the stock price in indices, in time step, right? A daily time step. We can do that in weekly time step too. But we all know that a stock price doesn't really behave that way. In a single day, the stock price can change multiple times. The change in stock price could be multiple times in just a single day, right? And so, rather than saying that the stock price is changing in, let it daily time step, weekly time step, hourly time step, no. Why not rather thinking that the stock price changes continuously? The change is continuous. So now we're going to move from that time step, which we call the discrete time geometric Brownian motion, to the continuous geometric Brownian motion. Let's look at it. So we are moving from discrete time to continuous time. So I want you to follow me here. This is where the calculus is going to enter. Now we know that the stock price in discrete time follows the process. So this is what we know in discrete time. In the limit of delta t, which is the time step approaching zero, in other words, if we say delta t is approaching zero, it means that the change in time is almost zero, or is approaching zero. In other words, then if you look at, let's say we are doing a time step in terms of annual terms. So from year 1 to year 2, that's about 365 days, right? Now, if we want to do the time step monthly, so from 1 month to another month, that's 30 days. It's too huge. Why not doing the time step weekly? Okay, from 1 week to another week, that's 7 days. That's too bad. Then another one is, why won't you do the time step daily? Okay, from 1 day to another is 1 day difference. Why not do it hourly? So from 6 o'clock to whatever, this is the hour. Like, look, we can keep reducing that. We can do the prediction minutes by minute, seconds by second, millisecond by millisecond, and then we get into a continuous world. So the change in time step is almost approaching zero. Once we get milliseconds, whatever, microsecond, we are almost approaching something where the change in time becomes extremely small. That is almost approaching zero. That's what we're saying. That if the limit of the change in time, or the delta t approaching zero, the time step is infinitesimal, then delta t tends to dt. Okay, dt is the calculus delta we know. So we can write this that that's the limit of the change in delta t approaching zero is dt. Mathematically, This is how we can write it. Now, if this is the case, then we are going to change all the delta t in the formula to dt. So we can rewrite the above equation as follows. So this is what we've done. Now let's proceed. Our aim is to derive an equation for a change in the stock price in continuous time. Because we cannot write the equation in this form. The reason is that if we say st plus delta t, where is it taking us to? Like, the time step is extremely small. That is almost going to be difficult, right? So we need to solve this. We are almost there. We are saying our aim is to derive an equation for a change in the stock price in continuous time. That's the instantaneous price change. And because the instantaneous price change is an assumption behind the log normal distribution properties of stock prices, right? Now, so when we move the st to the other side of the equation, we have st plus dt minus st, and this is the equation. Let's proceed. Now, we are going to drop the subscript. We will drop the subscript. So here you can see that there's no subscript written below this. We know that the st plus dt minus st is the same as ds. You can see that. It's the same as ds, and ds is delta s. So because the time step is delta t dt, so the time step is delta t, so the st plus delta t minus st must give us delta s, and that's what we have. So we have delta s here. So we drop the subscript. When we draw the subscript, we have this. This equation is what we call the geometric Brownian motion, but we are not done. We are not done yet. Now, we can rewrite the random component. This random component you see here, the sz sigma square root of dt, we can write it here. What we have done is that we have combined the z and delta and the square root of dt. The z and the square root of dt can be combined together. And when it's combined together and is written, it becomes dw. And the dw is what we call the Brownian motion. The w is what we call the Brownian motion. And the dw is the change in the Brownian motion, or the change in the process. And the Brownian motion, which is the w, is also called the Wiener's process. The Wiener process. And this is a hard concept, right? Don't forget, we're going to focus on the final result, and that's what we're going to be using. Here we're just solving the equation. So then the dw, which is the change in the process, is having a probability distribution. Is normally distributed with a mean of 0 and standard deviation, and a variance, let's say, and standard deviation of square root of dt. I should have written it in the variance form, but I've written it in the standard deviation form. So this is a bit error here. Now, so we can rewrite our equation for the change in the stock price in continuous time as follows. So this is the equation. This is a multi-billion-dollar equation. We call it the stochastic differential equation for the stock price. So this is the equation used by all the guys on the Wall Street when we are describing stock price using geometric Brownian motion. We call it the stochastic differential equation for the stock price. So this is the equation describing the change in stock price. So the change in the stock price is equal to the stock price times the growth rate in the stock price, or the expected return, times dt plus the stock price times volatility times the change in Wiener's process, or the W. Now, the whole idea is that we going to solve this differential equation. And if you have done calculus in a university, you have known how to solve differential equations. When we are solving differential equation, what we are trying to do when solving differential equation is that we are trying to make S the subject. We just want to make S the subject, but mathematicians don't say they are making S the subject. We just say we are solving the equation, but we are trying to make S the subject. As it is now, you cannot make S the subject. In fact, how do you make S the subject in this equation? And you may think that I'm going to divide through by D and cancel all the D. There are D's across. So I cancel a D here, I cancel a D here. I can't. No. That's wrong. we don't do it like that. The D's are not things we just cancel out. So these are differential equation. This is delta S or the S. And just like the way you have differential or differential calculus, right? So let's solve this equation. Let's get a solution. Now, so solving the SDE. So we found that a change in the stock price in continuous time follows a very beautiful process. And this is the process. And this is the process followed. And this is the process I showed you here. The same process is followed here, where the DW is the Wiener's process, and the DW is the same as Z to the square root of dt. Now, solving SDE for S, so meaning we want to make that a subject. And it requires some calculus, right? It requires some advanced knowledge in calculus. And we need to use what we call Ito's lemma. Lemma in mathematics, when we call something lemma as kind of like proofs, small proofs, mathematical proofs that we have, small proofs. They are not the end result, but they are means to an end, right? Small mathematical proofs you can use to prove a bigger thing, right? There are small proofs that are available mathematically. You can bring them to use to prove the bigger picture, right? We call them the lemma. And then the guy called Ito was a Japanese professor, and that brought out those lemmas, right? One is called the Ito's lemma. And you can, when you go to, let me just show you something quickly. Going to this side, let me show you an example of what I'm talking about. So if you come here, we have, and look at Ito's lemma. Ito's lemma. Let's see what you have. Ito's lemma. So Ito's lemma is a fundamental result in stochastic calculus. You see, I told you it's a result. And when I go to images, you'll see the Ito's lemmas that are used to prove the things we are doing there. Because what we are doing there is quite simple, but this is the Ito's lemma. Can you all see? Can you all see? Please, can you all see my the screen I'm sharing on the Ito's lemma? Please put something in there, whatever. Okay, great. So this is the Ito's lemma, and this is the lemma, the theorem that is used to calculate all that we have here. Let me tell you, it's not too difficult, but it will be difficult to you if you are not a math person. You will not even know what is going on. So there is a mathematical result that is used to prove whatever we are looking at. That's the Ito's lemma. Now let me go back to where I was. So the Ito's lemma is what is used to solve the stochastic differential equation. So when we apply Ito's lemma, we can use it to transform the above equation to this form. So when we transform the above equation, we have in delta, then ln is the log, the natural log of stock price is called to this. Now we're doing something wonderful. Now, by integrating above equation between time 0 and time t, we're going to integrate this between time 0 and time t. We obtain a closed form solution for the stock price in continuous time. This is what we call the stock price model. Here is it. The whole $1 million stock price model we use to simulate the stock price is this. And that is what you're seeing here. The ST, the stock price at any point in time, is equal to today's price times the times E, which is the Euler's identity, right? E to the power mu minus sigma squared divided by 2 T plus sigma, the Wiener's process, then multiplied by T. This is the stock price model. Now, knowing the stock price today, so we can predict the stock price at time T in a single step. So that is what we are going to do. This is what I want to show you. So we need to know the formula that we are dealing with, and that is what we're going to be using for all the analyses that we are going to be performing going forward. Just a moment. We are going to work with this stock price model for the simulation. And once we're done with the simulation, we are done for the day. So I know I'm grateful. You guys have been around. Richard, Ibrahima, Gilsborn, Mark Jordan, Ivan, Ezekiel, Nelson, Clem. Thank you very much. You've been around. And so stick around for the next few minutes for us to complete the simulation. Now let's go to our valuation template that we have. So let me take my valuation template and oh my goodness, been talking for a while now. So I'm going to actually create the last worksheet for the day, and that's, I'll call it simulation or Monte Carlo simulation. I think it's just one N, right? Monte Carlo simulation. And I want to, let me see. Okay, so Monte Carlo simulation here, and so let's say Monte Carlo simulation here, and then I want to do some basic stuff here. Let me delete everything below to start with. Let me delete everything below to start with. Let me delete everything below to start with. Now, so what we'll do, guys, we're going to come up with some basic assumptions before we can use the geometric Brownian motion, right? Let me do this here. And I'll tell you a beautiful story right after this, right? So stick around. There's a beautiful story I want to tell you about something regarding stock options. Then I will have, let me have some few things written here. Let me call, let's say data. This is the investment, this is data, right? Stock data. So let me call it stock data. And then I'm going to have, so this is the stock data. I'm going to have the various things here. And number one is I want to have the stock price. So estimated fair price. The fair price we've calculated. Let me go bring it up. And what is it? The fair price is this. And then let's do this. This is the fair price, and that's the price we've computed. The next thing that we need the mean and standard deviation. And the mean is more of like the growth rate, of course. And in this case, it should be my cost of equity. Cost of equity, and that is the mu. That's my mu. And then I need my volatility. And this I want to approximate it to be standard deviation. Let me see, standard deviation of earnings, historical earnings, right? Historical earnings. I mean, historical profit after tax. That'll be my volatility. And given this, the next thing I may want to do is to look at when, okay, so the time when it is a matter of saying, okay, so let's say valuation date. We have our valuation date here. And also I want to talk about investment horizon. How long then you want to hold this investment? Investment horizon. No, so I know investment horizon, but I don't want to call it maturity date. Maybe let me just say investment horizon. Right? Investment horizon is fine. Investment horizon. Let's check something quickly. I think we have all the variables that we need for the geometric Brownian motion. Just a second, guys. Let me get this here. One moment, please. Let me see. Okay, I think I let me check something here. Okay. Guys, please, 1 second, please. I'm looking for a data I want to use. Okay. 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 All right. Okay. I think this is okay. Um, one moment, please, guys. Okay. All right. All right. Thank you. It's something I want to quickly verify. I was trying to quickly verify something and I use for whatever I want to do. All right. Now, so what we're going to be doing is that I I want to actually determine the stock price at a particular time, maybe over multiple investment horizon. So I'm going to do for one, and when I finish for one, then we can just replicate for the rest. But this shouldn't take more than 10 minutes to run the model. I'm saying 10 minutes, 10 or even maximum of 15 minutes. Today is the final day, guys. So stick with me. So cost of equity is the mu, as I mentioned, and that's the same as the expected return on the stock. That's the expected return expected by stockholders. Standard deviation of earnings, we have that also here. And then the investment horizon. So we have the fair price here. Cost of equity, let's go and bring it. So we go for the cost of equity, which is this, 35% or 36% or something. Volatility of the earnings. Trust, that's what I'm coming to do. You don't have that data, but I have data on the entire banking sector from 2010, right? So I'm able to calculate some things here. So trust me that my standard deviation calculation here is going to be correct. Just trust it. At this point, I have nothing to do than to trust it. But I'm using sample estimate, right? I don't consider this as population data. So I'm going to use sample estimate. So I'm calculating the standard deviation of the net profits for GCB. The standard deviation of the net profit or GCB. But when I do that, it's kind of like going to be giving me things in maybe in a CD sense, right? So what I can rather do is that I'll rather be looking at standard deviation of the growth. Okay, I rather look at the standard deviation of the growth in the net profit, because if I just take the net profit like that, maybe a better thing I can do is that I can look at the standard deviation of the return on equity. That is a good thing to do, right? Yeah. If I take the return on equity, I can look at the standard deviation of the return on equity. And for the in the interest of time, I'm going to do that calculation and I'll present the result here for you to see. So I'll take the this one divided by the equity for the period. So this one, I'm doing the net profit for the year divided by total equity, right? For that same year. And I want to calculate the standard deviation of that. You can see what I'm doing, but don't worry. I'm doing this in another sheet. Just believe me that whatever I'm doing is correct. Okay, so I have that. I can calculate the standard deviation now. But you can also try it wherever you are. Standard deviation for a sample data like this. I calculated a standard deviation to be to be 19 point something percent. So let me bring the data result and put here. So essentially what I'm doing is that I'm looking at the standard deviation of the ROE, or the return on equity. That's what I'm doing. What is happening? Yeah. So standard deviation of ROE, let me put it here, of ROE, standard deviation of ROE, and that's 19.5%. And the equity, the cost of equity is 35%. Wonderful. Now, valuation date, we know the valuation date already, and that's what we have at the top. So maybe let me even delete it from here. And then we have the investment horizon. So this will be estimated fair price today. Okay. Then investment horizon, let's just say 5 years. Let's say 5 years now, and see how this is going to go. So let's create a table below and do something quickly. So what we are going to do below is that we are going to have some few things here. What we do, we will have simulations. Let me start simulation. And then we, for the simulation, we are going to run, let's say, in Python, I'm able to run maybe 500,000 or even 1 million, right? But here, let me run a simple simulation. I'll run up to like maybe 10,000. So I'm going to have sim 1 up to 10,000. So I'm going to run this up to 10,000. And then there are shorter ways of like dragging this down to the 10,000 number. That if I'm to teach Monte Carlo itself, I tend to start it by teaching sampling. If I teach you sampling, you'll get to understand why if I run 10,000, the result I'll get by running 10,000 simulations will resemble the result I'll get if I run 100,000 simulations. As I increase the number of sampling that I do, as I increase the number of sampling I do, my figures tend to converge, right? Yeah, that is one thing we often see. The figures that you run often tend to converge as you increase the number of sampling that you do. The figures tend to converge. Okay, so we are around 5,700. We'll get to 10,000 soon. Let's just give it a few seconds, and then we have that. Just a few seconds. So guys, hold on. We're doing this in time. So let's just give us that few whatever, and then you have our figures. Okay. Okay. We have 9,000. Almost there. Okay, we read 10,000 is actually up to 10,000. Let me go back a bit. I want it to be exactly 10,000, right? So we have the 10,000. Shortly, we have 10,000. 10,000 now. Okay, good. I have my 10,000. Good. Right. So let me go back to this side. So I have my 10,000 simulations here, and I'm going to do some sampling. And I told you that the winners process, of course, we need to sample the randomness in the stock price. We need to sample some random variables. So we're going to sample that from the uniform distribution. Now, the uniform distribution, random sample, distribution, random samples. We'll sample from a distribution that is uniform. That's what we're going to do. Okay. So, and then you'll be wondering, which distribution is that? Well, it's going to be a uniform distribution. A uniform distribution is that distribution where each element actually has equal probability, right? Let me pull this here. And then I think today I was checking something. I think it's here. Good. So let's do that kind of like uniform distribution. Let's see how it looks like. So we're going to sample from the uniform distribution. And the simple formula to sample those random numbers is use rand, the rand function. So the rand function helps you to sample from that. And then I drag down. There are a lot of things that are happening here. And, researchers often are thinking whether the random number generator in Excel is actually doing a good job, right? There are a whole book written on Monte Carlo on things like this. Now, here, given that we can actually determine the terminal price of the stock price, what should be the stock price? We can forecast the stock price on any day. One thing is that once you press F9, you see the stock price or you see the random numbers changing. Either you rerun or each time the Excel or calculate something, you see the random numbers changing. So it tends to slow down your Excel, right? Those are some of the challenges I have when I use this. So it tends to slow down my Excel. I want to also see a change in price, the stock price. I want to also see a column that looked at change in stock price. So let's check that also. Now, so with this we have, I want to make these to 4 decimal places. And of course, it has affected whatsoever I have here. And I know this is a percentage. I know this is also a percentage. Okay, good. Now the terminal price. So we need to actually do the simulation now. Let me use this here, and we need to do the simulation, guys. And this is the big part. Let's put in the formula. We saw the formula earlier in the PowerPoint. And what was the formula? This is the formula. We take the stock price today, we multiply by e to the power mu minus sigma squared divided by 2, and then sigma squared divided by 2. Then we also multiply the rest of the numbers there by t, and then we do the mu, then WT. And we said WT will be sampled in a manner, but the actual implementation of the WT is going to be, let me check something. The actual implementation of the WT is going to be, we're going to take the z-score there and multiply it by the square root of time. Okay, the z-score multiplied by the square root of time. Now, there is a way we derive the z-score. The z-score, we derive it by using something, the norms-inf formula. Let me show you what I mean by norms-inf. So come here. To get a z-score, since I have the random numbers, all I have to do is this. I have norms-inf, and then I put the z-score there. It gives me, I put the random number there. It gives me the z-score. Oh, sorry. Norms-inf, not norm-inf. It's a norms, it's one with S. The meaning of this is the inverse of the standard normal distribution, right? I'm inverting that. I think, okay, correct now. I think, let me check something again. Norms-inf, okay. So it is something like that rather than what I brought in first. Then this is the measure. What we are doing actually is this more of like a probability measure. What it means is this. These random numbers are coming from between 1 and 0, okay, between 0 and 1. So this, if I draw the normal distribution, because I don't have much time, sometimes it's difficult to show some of these things, given that I don't have much time. But let me just do something quickly to show you something. This is the white. What is the whiteboard? This is a whiteboard. Okay. Continue. Opening whiteboard will stop the screen. Oh yeah, I know. We'll stop the screen. Good. Let me just show you something quickly. The whiteboard is almost away. Let me show you something quickly. Why is it taking long for the whiteboard to load? This is bad, man. Oh, new whiteboard. So what's happening here is this. I want to show you. Don't show this again. Yeah, don't show this again. Okay, everything is now loading. Finally here. Now, so all that's happening here is this. If I take a normal distribution, what is happening is that, so I take the normal distribution here, then the total probability under the normal distribution is 100%. So the middle here is 50%. So the probability is 50%, 50% to the right, 50% to the low, the left, okay? Something like it. It's 50% to the left, 50% to the right. Good. So if I say that the hypothesis testing we are doing, and what we are doing here is hypothesis testing. We want to see, this is the stock price distribution. We want to see what's the probability that there's a stock price that is at 30%, right? So the 30%, let's say, is somewhere here. So what's the probability that the stock price is, okay, given a 30% probability, what would the stock price be? Well, the stock price is to the left here. So you're having a stock price that can be tracked somewhere here. Not that the stock price will be tracked somewhere, that the return on the stock price will be tracked somewhere here. Don't forget, the stock price on distribution is log normal, right? It's log normal in its own right. But the return on the stock price is normally distributed. So the return on the stock price, given 30% probability, what will be the return on the stock price? We gauge it that the return will be this. And of course, we will use this probability to determine how the stock price location will be. So if the probability is rather 80%, then what will be the stock price whose return corresponds to this position, this location? When the probability is 50%, so here is the middle. What is the stock price whose return corresponds to this 50% probability? That is what we are trying to do. So when we go back to our workbook, our original screen, what we're trying to do is that we have the probabilities sampled from here. And these probabilities that are sampled from here, if I plot them out, you could see that the probabilities are, because I've sampled enough, the sampling variance or sampling error will be, I know, like hugely reduced, right? So we want to calculate the stock price, the terminal stock price that correspond to each of these probabilities. That's what we want to do. Now, so what we are saying is this. We are saying that we're going to use that formula. And once again, let me show you the formula before I put it in. Once again, the formula is this. We are using this to determine the stock price. The ST is whatsoever time we want to forecast the stock price to. The current stock price, then multiply by the various items there. So let's check it out. So we move here, and the first thing we need a current stock price. So we're going to anchor the current stock price. So what's the current stock price? 12.59. That is the estimated fair price today. What we are doing, 12.59. And then we anchor it. Then we said that it should be the stock price times E, and E is the exponential function here. Then it's going to carry some variable, some values. So it's going to, the first one that is going to take is going to look at the expected return, which is the cost of equity. And so we pick the cost of equity, and we need to anchor that as well, because we don't expect that to change. Don't forget, we did some capital market expectations, right? And so that minus, then we have half, right? Half is the 0.5. 0.5 is half. Sorry, I put a percentage sign by it. And then we do half times sigma squared. And half times sigma squared, sigma is a volatility here. So sigma squared, we just have to, we're dealing with sigma squared. We just have to multiply sigma by 2, right? And that is what we are interested in. Then that's cool, right? Sigma by 2, that's sigma squared. So that is what the formula is saying. And then after doing that, we close the bracket. So if you check what we have just done so far, I want to show you the portion of, or the part of the model we just solved. We've done the S naught times e to the power mu minus sigma squared divided by 2. That's what I mean by half times sigma squared. That's what we've done. So going forward, the next step will be to multiply it by t, this t here. So let's do that quickly. So we go back and we are going to multiply this by t. And t is kind of like over what period you want to forecast this stock price over 1 year. So we multiply that by the 1 here. Then we anchor that as well. In fact, all the things we are doing, we need to anchor them. We need to anchor this one too. We need to anchor this one too. They are all anchored, right? They are all anchored. So we don't want them to be moving when we move, when we start moving. Then the second portion is there is a plus. And what we are going to do now is that we are going to deal with the aspect that handles the variance aspect of things. So we're going to start doing the variance aspect of things. So we're having variance, the volatility. The volatility side, so I'm talking about the stochastic side we are moving to now. And when I say the stochastic side, I mean this you've seen here, this particular side, the one that is, where is my cursor? My cursor is kind of messing up now. Okay. So I mean, this is what I mean. The sigma times the WT, sigma times W as a function of T, right? Sigma times W as a function of T. So the sigma is what we call the volatility, and the W is what I mean by the process, which is the Z divided by the square root of T. So let's multiply by the square root of T. Let's take this now. So we are going to take the volatility now, and that's the next thing we want to handle. So we pick the volatility, which is this, right? We pick the volatility, which is this, and we anchor it as well. Then what is next after the volatility? This is where we need to bring the Z-score. The Z-score, you and I, we've been discussing the Z-score, and I said you use the norms, what is it? Norm S inf. I have it here. Then it takes on a variable called the rand, and that's what we have here. And that one will not be anchored. That one will not be anchored. It won't be anchored because we want the terminal price to vary across the various predictions. And once you do that, the next thing you do is to take the square root of time. And the time is to the investment horizon we have here. And that must also be anchored. So this is a formula. When I hit enter, it's going to give us, let me bring another listing. It's going to give us the stock price in 1 year time based on the first simulation. Good. So this is the stock price in 1 year time based on first simulation. 17.58, the stock price in 1 year time. There's one thing I want you to know. Because I am dealing with, I've multiplied the time step I've used in my work is 1. So it means that this is annual, right? This annual, it means that the cost of equity here must also be annual cost of equity. And then volatility here too is annual volatility. Now, so with all this we've just done, I believe we've held a rest of the things, or we've logged them in a section of the rand we can drag through. Now I've dragged through, and I want these to be 2 decimal places. Okay, next thing will be to calculate the change in price, which will be the terminal price minus the current price. So that's the change, or the change in price, right? Terminal price minus the current price. So the change in price is this. This is what we have as a change in price. Now, what we're going to do next, now that we have all this done, is that I want us to do something quickly and have these plotted in a way. So we can start a plotting even from here. What I'm going to do is that let me quickly run down and check something. The 100,000 value here, oh, sorry, the 10,000 value here is 120. I want to write something at the top so I don't have to be going all the down all the time. So A1, so 120. So I have from 21 to 120. Okay, good. I have it here now. This one I'm going to be using throughout my work, period. Now, so what am I going to do? I want to create some tables. Before I create that, I want to be able to plot these prices. So I'm going to collect this. I want to plot the price changes, right? I want to plot the price changes. So I'm going to be collecting this, and I'll be plotting the change in price as per the various simulations that I've just run. I want to show you something quickly. So I've been able to collect everything now. So I'm going to go to insert, and then I'll go to just a simple plot, something like this. And this is what it gives me over time. This is not something which you may really be expecting. Of course, it's not a beautiful plot as you may be thinking. Sometimes when I look at this, I ask myself whether I should even whether I should even waste my time that I'm plotting. I'm plotting it actually, but it's kind of like it's not giving me a good P&L that I really want to plot. So sometimes when I do this and I ask myself whether it's necessary for me to even plot this at all. Just a moment. One moment, please. So maybe let me leave it. Let me take this off for now, and let me focus on something else, at least for now. I want us to be able to plot this. So you remember in your high school, you did some statistics, right? Let me show you what you did in high school, and that's what we are going to use to derive something, then we are done. Okay, what are we going to do? In high school, we learned this. I want to call this bin. I want to call this the bin. Sometimes in high school, we call it price. We call it class size and all those things, right? Then let's have marginal frequency, marginal frequency. And then I want the absolute marginal frequency. And then I am going to do another thing here. I'll call this the marginal frequency again, marginal frequency, but this one will be relative. Guys, you have to stick with me. You know, I've been speaking all this far, right? So you are going nowhere. At least, as far as tonight is concerned, we need to close this, and it's getting interesting. So let's just do that. And the last thing I want to do, when I have marginal, then I must have cumulative, right? Cumulative frequency. And then we also have, so we will have cumulative frequency for absolute, and then we have cumulative frequency for relative as well. So this for absolute, and let me expand this, and then you have cumulative frequency for relative as well. You see that each time I run the SL, everything recalculates again. That's the interesting thing with the work. Relative frequency as well. Okay, so let's see how things go. We have cumulative frequencies and all done here. And then the last thing I want us to do, okay, maybe we can end it there for the cumulative and the absolute, the frequencies and all those kind of stuff. I think it is fine now. One thing I want to do is to determine the terminal price. What is the terminal price of GCD stock based on the fair price today that we are using? The terminal price will be equal to the average it will be equal to the average of F21 column F10020. Okay, that will capture the entire 10,000 path, the path. Oh, I put it at 21. No, I put it at changing price. Yeah, good. I brought it back to terminal price. Yeah, the terminal price here. Let's check it out. It's 17.67. That's what the price would be. Now, let's check these few things that we have here. Let's check it there. So we're going to define some basic parameters here. I want us to define some basic things like the minimum price. You look for the minimum price change, and we look for the maximum price change as well. Then we have the bean size. Then we have the beans and we have the bean size as well. We have the bean size as well, and here we have counts. Okay, so the minimum price change is we got to calculate that, and then the maximum price change, we are going to calculate that as well. Then we are going to calculate the bean size, or we will determine the bean size, or sorry, the total bean, and then we also determine the bean size, and then based on the bean we are looking at, and finally we have the count. So let's look at something, the minimum. How do we calculate minimum? We bring the minimum function here, and then we are going to work with the price change. So we have F21 dash F10020. So what do we have? The minimum price change as predicted here is 4.3. So we are trying to say that between today and 1 year time, the minimum price change will be 4.3 based on our model. If I press F9, you'll see this value changing. You see, I press F9, this value is expected to change. And if I rerun the formula, the value keeps changing. You see how it keeps changing? It changes to 4.41 and all that. Then we can also do for mass. This is the minimum. We can also do for maximum. So for maximum, I just have to change the mean to mass. We have the maximum. This is the maximum price change. So this is the range, the range or the range of price change, and that is it. We are looking at now. So there is something I want to do here quickly. When I say the bean size, I'm in effect saying like you're going to see it soon, how we construct the class size and all those things. I want to put the bean size so that I can really get a lot of values. And maybe let me put the bean size at maybe 15. I think 15 will do. Now, so based on 15 or number of beans, or in other words, number of classes, you know, I kind of grouping, or I'm talking about class size. The number of class size I want to do 20, but then that is going to depend on something, right? It's going to depend on the minimum and the maximum stuff I'm having here. So the class size here, in effect, will be the if you check something, guys, you realize that I've never had any negative price change, right? It appears all my price change have been positive. And it's all because the cost of equity is very high. It's higher than the volatility. Maybe my volatility measure is too small. Yeah. So I do the maximum minus the minimum, and then I divide that by the bean size. So maybe I can put my bean size rather even at 10. So I divide by the bean size. I can put the bean size at 10 instead. What is happening? I think I didn't do this well. So I said maximum minus the minimum, this size. Okay, so maybe let me put the bean size at 10 because of this. And the counts, I have, the counts will be, so I have the count as, so count function, and I have this here. So I put F here, and I put F here as well. So we'll capture that. So I have this as 100,000, and as for 10,000, sorry, we're working with 10,000. I've been mentioning 100,000, working with 10,000. Now, so how are we going to work with these things? It's going to be a simple thing we're going to be doing with the way we work with the class size and blah, 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 not anything difficult at all. So what we're going to do is that the first bin size or bin will be the minimum. And then going forward, it will be the minimum here plus the bin size. The bin size is 0.16. So let's see. So we're going to do that up to 10. By the time we get to the 10th element, oh, I think I made a mistake. I have to lock these. I have to lock it. I have to log the change. So by the time we get to the 10th value, it will all be, so we have up to 10. So it will be up to the value we have here. And so currently it is this. Let me take another step. Then it's exactly the value we have here, right? So the maximum is 5.88. You see the 5.88. So the number of values here is 11, but the grouping between 4.23 to 4.4, from 4.4 to 4.5, of course, the change is up to 10. That's why we have the bins up to 10. Then the next thing we're going to be doing is to do something we call the marginal frequency. And the marginal frequency actually is something which we all know and we've been doing, and shouldn't be anything difficult, right? So we use frequency formula. There's a function called frequency, and then we put a data array. The data array is simply I don't want to keep dragging things because we don't have time. So I copied this somewhere. So I'm putting this data array, and the next data array to put is the bin, So I put a bin as well. When I click enter, it will populate everywhere. So they are all populated. Once I click enter, these are array formulas. In the old versions of Excel, you need to press Ctrl+Shift+Enter, but now it is really quick, right? So we have marginal frequency, and this is absolute marginal frequency. Then we need to do the relative marginal frequency. And now, once we calculate absolute marginal frequency, calculating relative marginal frequency should not be that difficult to do, right? And once we have the absolute marginal frequency, relative shouldn't be anything difficult. Now, when I sum up all the absolute marginal frequency, I'll have 10,000. Let's check it. Yeah, I have 10,000. So my calculations is right. So let's look at the relative marginal frequency. And if you do elective maths in high school, you have seen relative marginal frequency. That is whatsoever you have here, the marginal frequency divided by the count, and we can log the count. You enter that. When you do it, the total sum must be 100%. So we have this here, and when I sum it up, it must be 100%, which is correct. Next is to do cumulative absolute frequency. So the first one, you have this. Then the second period, you have the previous period plus this one. And then here we have the 10,000 recorded, as you want to see, the 10,000 recorded. Okay, then the relative cumulative frequency too, you do the same. We have these, and then the following year, we have these plus this. And then we can drag to the end, it's 100%. Now I can put all these in a very nice table, and then I put all this in a very nice table. And one thing I can do out of what I've done will be to plot some graphs. And plotting some graph is in place. And I can plot a graph on the basis of the marginal frequency, and that will be the probability density function of the prediction. So marginal frequency, I can plot a graph on that basis. So I go here, I go to insert, review, let me see, insert, yes, insert, I go for some line graph, some nice line graph, I plotted this, and this is my PDF. This is my probability density function. And this probability density function is normally distributed because I'm doing this on returns. And you know, because we are looking at change in stock price, so that is a return, right? The change in stock price is a return measure, and returns are normally distributed. So but the price, the stock price themselves are log normally distributed. So I can call this the profit or loss PDF, probability density function. The profit or loss PDF. We can call that the profit or loss PDF. Now, so this is a PDF, a probability density function, and you can see how it's nicely normally distributed because the stock returns are expected to be normally distributed. That is what is happening. And then with this also, this is a very beautiful one, right? This also, we can also plot the CDF or the cumulative probability distribution. The CDF can also, the cumulative density function, sorry, can also be plotted. And we go to this side as well, and we are looking for the CDS. We can plot the CDF also just by it. So this is a CDF. And I want to use the other color outline. So this is the cumulative density function for the whatever. So this is a profit or loss CDF. The profit or loss CDF. Profit and loss CDF. So this is CDF for the profit or loss, and this is the PDF for the profit or loss, profit and loss, P&L. Okay, so this is what we have. So you can actually see what is happening now, and all because volatility is low. For me, volatility should have been higher than the stock price because volatility tends to be smaller than the stock price, and over a longer period of time, the stock return tend to dominate. I want to show you something. In a short period of time, volatility dominates in the short term, but in the longer term, the expected return on the stock actually dominates. There is something else I can do here. If I copy this, I bring it down. This is the last thing I'm doing, guys. Then we close. If I copy this and I bring this down, and the beans I'm using, let me take this to this side. Let's see, I copied it and I paste it down here. I paste it down here. Then you're going to see something very interesting. I'm going to copy this also. Currently, let me put some colors by it. And I'm going to bring it down here. Bring it down here. I want to do for the stock price as well. So here at the minimum price, I'm going to come here, copy the same formula and bring it here. And dump it here. But now, instead of change in stock price, it will be on the stock price. That's one. And I'm going to do the same for the minimum as well. Instead of the change in stock price, it will be the stock price itself, right? But then for the maximum, sorry. And then I'll put maximum here. Wonderful, wonderful work. Now, the next thing I'll do is the bin size, I'll still maintain it as 10. And then the bin I'll maintain as 10. Bin size is automatically calculated. The count will be, I still take this and I bring this here. You see what is going to happen, what we're going to produce out. Something powerful we're going to produce out. So this also is here. And what is next to be done is, we have everything. We have the bin, and then I need to bring this bin size. We're going to now use the bin size here. The bin size here is what we're going to be using. And this will be used throughout from here down to the bottom here. This is a bin size we are going to be using. Good. So what's the marginal frequency? we are now going to use, I calculated this, I did something here. Let me copy this and rather bring to this side. So we have this marginal frequency like this. Now, this is in column E, right? The stock price and things are in column E. So I enter, no, that will not work. That will not work because I need to also bring here the bin, whatever. So let's do hit enter, bam, we have it. We have it. So we have the, we have this also calculated. Let's do it properly. So the count is still on this one. Let me bring it up here. Then I have my count here. I can now drag to the end. Give me my count. And then we have the cumulative all done here. We have all this cumulative also done. Now, when you work with change in stock prices, we know that the P&L for stock price, the P&L for stock price simulated is normally distributed. We have the probability density function. But when we work with stock prices rather than changes in stock prices, then we are going to get something different, right? We'll get something different. And what we're going to have will be also normal, but it will be log normally distributed. And we can plot that as well. We can plot that as well here. There's something I'm checking quickly before I do this plotting. I want to check that quickly before I do the plotting. A second. There's something I want to plot, and of course that's the last plotting we are doing. I'm trying to get something here. I'm trying to get something here to plot. Okay. Okay, so now we have our marginal frequency and all this kind of stuff here, that it tells us the density of the stock prices that we're going to be plotting. One thing is that when we're doing some of these plotting, the y-axis is going to be the frequency, the marginal frequency, right? And the x-axis likely has to do with the price, right? The price, which is the bin size that we have here. And that's what I'm trying to do. So I think, let me check out something here. Suddenly, I've forgotten my graph theory. I think if I hold this and let me hold this and this alone and see. Shift key. Oh, it copies everything. I don't even need some of these things. I don't know if I need a help. Suddenly, okay, so let me plot this first. Let me plot the marginal frequency, and then I'll see how to do with that. So I go to insert, and this is the last graph we're plotting. Then we conclude for the day. Okay, so I have my marginal frequency, and then I have my marginal frequency. Then I want to go back and update my graph. And so let's update graph, and I have the horizontal axis here being these values. Maybe let me pick these ones instead to see how it looks like. Good, I've gotten what I'm looking for. Oops, I think I've changed again. I'm not sure that is it. Okay, let me do it again. Copy, then I go here and I select my axis here and I apply the OK Okay, good. This is what I'm looking for. That's what I'm looking for. So this is a log normal distribution of stock prices. And even if the expected returns negative, sorry, the change in stock price is negative, this will still be positive, right? The stock price would never run to negative. This will still be the positive value. And then so I'm going to call it the log normal distribution of stock prices. So that is exactly what we want to do. And I'm glad that we've been able to come up with this. So we can say log normal distribution, or okay, let's see, stock price distribution. Let me not say stock price, let's say fair value of stock price, fair value of stock price distribution. So this is the distribution of the stock price and is log normal. Okay, so now what is the whole sense in all this we've been doing? This is beautiful. Yes, we have simulated about 10,000 possible paths. And all this is beautiful. But this is what I want to do with all this, right? Go to my valuation summary. I want to come out with probability distribution. So this is my final table, probability distribution of the stock prices. So I come here and I say probability distribution of fair value. So what am I going to do with this probability distribution? I am going to do the following. I will say that I'm doing a probability distribution in multiple time period, 1 year, and then 2 years, 2 years, or let me just do 1 year, 5 years, and 10 years. This is the probability distribution. What would be the expected stock price? Expected fair value of the stock price. And then that is 1. Expected fair value of the stock price, that is 1. Then the second thing to also calculate, so this is expected fair value of the stock price. And okay, maybe I will not need any other thing to do again. Sometimes what we will need to do with some of these things will be to come up with the confidence interval to which we are estimating some of these parameters, right? We can come up with a confidence interval for estimation, but I think let me leave it here. I will not do that. You can look at it yourself to do, but I'm just going to look at what should be the expected stock price. And someone will say, if I say probability distribution, so where is the distribution? So this is coming from Monte Carlo. And maybe instead of saying probability distribution or whatever, the thing I should have added, let me not just throw in a towel there. The thing I should have added should be the price change, and the price change is one that I could have added to this. The price change. So let's look at it. 1 year, what should be the fair price? So I'm going to go run the simulation. This is 1 year. So I know the fair price is this in 1 year time. In 1 year time, I have it. Terminal state or future state. Terminal or future state. So 1 year. Is that okay? Now, 5 years time, how will it be? Well, one thing I want you to know, because I'm running this simulation and things keep changing. So the figures will keep changing. One way you can stop the figures from changing is to simulate more. But this is not changing even much. Look at 17 point. Look at this. 17 I wanted to check this as I ran this. 17.67. Let me run this. 17.67. It's actually not changing. And that's what I should have demonstrated to you before doing the Monte Carlo. It's not changing. The average is not changing. Because once you simulate a lot, 10, 100,000, 1 million, for 1 million, you don't even see that anything is changing. Okay. So this is for 1 day. This is for 1 day. Now, for 2 years, or for 1 year, for 2 years, I just change this to 2. Look at what I have. 35. I copy, I place here. No, I need 5 years instead. I just put here 5. 5 years will be 88. I copy, I place here. You'll be wondering if this 88, this thing is what I'm saying, make any sense. And then 10 years, I make this 10. Will be 171, 176. I'll tell you why we are having these big figures. We are having a big figures before because we are having a lower volatility. And I have a lower volatility, but the case is that am I the cause of it? Maybe the manner in which I calculate the volatility. Because if you look at it, the bank is a risky business. I can't just say the volatility in return on equity will be the best measure of volatility. So somebody can challenge me on that, right? Fair value. So Monte Carlo. Okay, so the question then is, does this the manner in which I have this predicted, if I change this to worst case scenario, let's see worst case scenario and see how the bank distribution will be. Worst case scenario, the whole thing is that the things in expected value, however, will not change. But if you look at the Monte Carlo, to run the Monte Carlo, worst case, in 5 years' time, you want the bank's value to be at 38. That's worst case scenario. Do I say worst case scenario? Yes, but the parameters are not changing. So, in fact, it's not impacting it. It's not impacting it because these ones are not based on those kind of worst case or whatever. If I want to do worst case, best case, this thing for it, then have to be around the parameters and see how the parameters are changing. So if you are making an investment and you are making a portfolio manager, you are looking at the price and you want to see what would be the portfolio distribution in a year's time, 5 years time, 10 years time, and you come to Monte Carlo and say, hey, wait a minute. In 10 years time, that's the 10-year investment horizon. This is my portfolio distribution. So this is the frequency distribution table. You can see it for the stock price. And here, you have the fair price. So this is the distribution of stock return or stock price in 10 years' time. This is the distribution in 10 years' time. Okay, in 10 years' time, the stock price is log normally distributed in this manner. In 10 years' time. Now, if you come to the change in stock price, the price change, this is the distribution. Even this, I want to, let me come, because I've done the same for the other one, let me select the data properly because I should have added this to it. Let me use the bean rather, the bean, so I have a better data, so this is the distribution of the, what am I doing? I think, is there a mistake here or something? The price change. Okay, this is a 10 years time price change. In a 10 years time, see the price change. Okay, see the price change in 10 years time. It's quite huge because 10 is a longer period. If I make this just 1 year, you see how the price change is going to be smaller. So this is the price change now. The distribution of the price change. So you can calculate the expected price change. And the expected price change is what we have here, which is the 17.67 minus the current price. The current price, okay? The current price, which is 12.59. So the price change is just 5 CD. The expected price change, okay? So to fulfill all righteousness, let me change this also. Let me get the data again, and so I can put in the bean here. Then I enter here, and so this gives us that. Now, good job done today, and one thing I did here to put the cost of equity at 35.79. So this is the return as per my cost of equity, which the actual stock return may be lower than my cost of equity. But because I'm doing projections, with the expected return formulation must be used. And that is what I've used here. And the volatility could be more than this if perhaps we calculate it in or using another method. Maybe the volatility on it could be on the yields or something that really dominates the bank's report. But a lot of things the bank reports are quite stable actually. We can use volatility something else, maybe the NPLs or something else, and that could even be higher than the cost of what we have here. So we have this huge distribution, all because a non-negative changes or P&L, or because we are having a higher cost of equity, and in the long term, the cost of equity dominates. So this is not an investment advice. This is just to show. So you can always contact me and to discuss these things more. And also, you can run this yourself, think through it again, and look at maybe a better way you can use to simulate some of these things. Thank you very much. Let me see if there's any question. Any question? You've been with me 9:30 now. 4 good hours we've been doing this. 4 good hours. I've been talking for 4 good hours. What I want to do is that I would just want to put some borders around this, and then we call it a great night, a night to be remembered. I mean, a night to remember. You see, a lot of the research reports I actually see several people publishing. A lot of people now, especially those who are not publishing in the name of any corporation, what they tend to do sometimes is amazing, right? In terms of the assumptions made, sometimes are not quite good assumptions, especially, and those are the things that pique my interest to do this program, right? I contacted CFA program that we can do this together, right? A lot of people in the market don't do this well. They formulate assumptions around banks, just like the way they do for industrial corporates, and sometimes it's amazing when you see things like that. How some of those things are done. They formulate those assumptions, and you'll be wondering if whether they're going to get any good results at the end of the day. So our valuation is not bad. This is what we have as a distribution using a Monte Carlo, and we also have here our upside. The upside is quite good from the price analysis we did. Cost of equity, we've done that. The market multiples, and so we've been able to do the things that we want to do. So when you put in together this research report and all that, your assumptions must all be included. Talk about the macroeconomic side. I could get I will soak it again and come back if I have any questions. Okay, great. Zaid, assumptions are sometimes scary. I share in your concerns, but hopefully your lectures will make a difference from today. Yeah, great. That's my objective. That's my hope, that the lectures make a difference. So some of those assumptions and there's a wide disparity in cost of what they end up doing, and bit. Sometimes they don't even consider the models properly when the valuation models when they are making their final decisions, and some of the models may not be good in some cases. You see the way I put the weight on them because of some kind of experience I have dealing with some of these. Generally, it was a great time we have, and I really enjoyed the moment with you as well. Very great. I hope you are getting all the materials by tomorrow. Yeah, of course. I can confidently say that I shared my material so far with Ifri, in exception of the ones I used today. I can confidently say that I have no business with Ifri as far as materials are concerned. So I'm going to work and arrange this also, and then and God has shared with you. Also impression. about the lectures. I have just about 7 people on a call together with myself and Ifree. Let me hear from you. Today, the last day. Ifree, can they unmute? You can unmute and speak. Ifree has been doing so well. She's a wonderful person. Ifree, can they unmute, given that today is the final day?
Okay, so if we don't have any other updates, then we can just wrap up and I would end the streaming and then we can have a chat after that. That works.
We can have a chat. Great.
Yeah.
Great. So there's no other update. That is it for the program. We've been running for some time now, and it's been quite heavy. But one thing I want to tell you is that there are a lot of integration going on in the formula here. And what I've done is what we call the use of the ethos lemma, right, for stock pricing. Using the continuous geometric continuous time geometric Brownian motion. Brownian motion. So ethos lemma. Ethos lemma application. Yeah, something like this. Of course, I don't know who will get my video, so I need to ensure that I stick to the discipline of the finance profession. Great. So when you do the CF, there's one thing I want to say, guys. I told you I'll tell a story. I forgot about the option pricing. So what happens is this: once you forecast the stock price using this formula, the formula we use to forecast the terminal price. Once we get a terminal price like this, then we determine whether the option is at the money, is in the money, at the money, or out of the money at this point, at the terminal price. So we determine that, and whenever the option is in the money, we calculate the payoff. We calculate the payoff. Then we discount all the payoff back. Okay, we discount all the payoff back to today. And then when discounted back to today, and we sum it up, we calculate the average, then that gives us the option price. That price must or will be equal to the price that the Black-Scholes equation will produce. So, and the quality of that price will increase, okay? The accuracy of that price will increase the more and more simulation you do. Here we do 10,000 simulation. If you increase it to 100,000, 200,000, 1 million, 10 million, you approximate the Black-Scholes equation using this. So the same formula we use is the same formula that is used for in the derivation of the Black-Scholes equation. So that is how you can approximate the Black-Scholes equation. But the powerful part of this, the reason why this method is more powerful in that case is that the Black-Scholes equation is that even if the option is not the plain vanilla option, like the simple cost and put, you can still value those over the counter options using the Black-Scholes, because in the Black-Scholes equation, assumptions such as something like interest rate is assumed to be constant, volatility is expected to be constant, the strike price is constant, and that may not work with several other options like Asian options, where the price depends on the path taken by the strike price depends on the path taken by the stock price. You can use the Black-Scholes to price it. Barrier options, look back options, you can use the Black-Scholes to price them. So, and also on the market, you see that the crazy guys there and telling you that the volatility is not constant. So the Black-Scholes cannot be used. So what then do? You used to use volatility forecasting models like the Heston model and all that, the local volatility surface and all those kind of stuff. And Monte Carlo then becomes the game changer. It's the gold standard for pricing of products on the market, period. Monte Carlo is a gold standard for pricing. And every equity instrument, equity derivative price, mostly use the geometric Brownian motion, the way I've done it. Good, thank you. That's the second thing I want to add to it. And so we can, I think we can stop the recording now. Learned a lot during this day. House of J. Thank you, Ibrahima. All right, so you can stop the recording now. So guys, let me hear from you. The next 5 minutes, then we leave here. Ifree, can you hear me? LA free.
Julius, please give me a second.
Yeah, you can stop the recording now. So I'm done. You can stop the recording.